Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
Just give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg First Word News. Joe Biden and Kamala Harris will appear together in a virtual fundraiser today. It's their first appearance since the Democratic presidential candidate made the California senator his running mate. Harris is the first black woman and first Asian American on a major party presidential ticket. The stimulus stalemate drags on. The principals in the negotiations to get a new virus relief package haven't spoken since Friday. The White House says Democrats must reduce their demands for $600 a week in unemployment relief and for aid to state and local governments. Democrats say Republicans must put another $1 trillion on the table in addition to their original $1 trillion offer. The U.S. government has reached a deal with another potential maker of coronavirus vaccine. Moderna will supply 100 million doses of its experimental shot in an agreement valued at up to $1.5 billion. The company already is getting $955 million in government aid to test the vaccine. And in New Zealand, the city of Auckland is back in a 3-day lockdown. That's after the country's first local coronavirus cases were discovered in 102 days. Authorities are now trying to trace the infections. New Zealand wants to avoid what happened in Australia, Japan, and Vietnam. Those countries had early success in fighting the virus, but now see it coming back. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Lisa.
Thank you so much, Ritika. Meanwhile, in markets, we're seeing a risk-on feel pretty much across the board. Today, we're seeing a more traditional feel when you look under the hood. NASDAQ futures leading the charge up almost 1%. S&P up, trailing that at 0.8%. Yields higher, 10-year yields hitting at 0.67% ahead of that $38 billion auction later today. And oil hovering near the highest since March, just pushing a little bit higher as stockpiles in the U.S. come down just a little bit. Trying to make sense of this in the positioning at a time when you're looking at really poor economic data coming out of the likes of the United Kingdom and the jobless reports out of the United States with the incredible amount of stimulus. Is Joe Amato. He is Neuberger Berman, President and Chief Investment Officer of Equities. Joe, right now, looking at the trade of the moment, which is big tech, out of favor for all of 2 or 3 days. Now we're seeing it back in favor. Do you see this sort of rotation into cyclical names having longer legs going forward?
I think. Good morning. Good to be with you. I think at some point there will be a very powerful rotation, more sustained rotation into value. But I think for that to happen, you need to see a more durable and sustained economic recovery. And so I think you'll see these fits and starts a bit as valuations get extended in growth, and folks will rotate back in a bit. So I don't necessarily think this is the rotation, for growth out of value at this point in time. I think we need to see more confirmation of improvement in the economic data.
You know, when I look at the economic data in the morning and I look at markets, I try to come up with a narrative. It's getting harder and harder to understand what the narrative is. Joe, does the economic data even matter at this point, or is it all about just how much money central banks and governments around the world are going to pump into the system?
Certainly fiscal and monetary stimulus, in particular monetary stimulus support remains, extraordinary and is really driving valuations in the short term. I do think the economic data matters. I think markets are reflecting two things. One is the liquidity that is extraordinary, and the other is, equity markets have always been a forward discounting mechanism. So I think there is a view that we will get through this. I think some of the optimism just over the course of the last week or two has been around a sense of the peaking of the caseload here in the U.S. So equity markets always look forward, whether it be forward discounting earnings or other events. And I think that's the inconsistency that most people look at right now, which is where the near-term current economic data is and what markets are showing.
Joseph, what does a Biden-Harris ticket actually mean for investors?
Well, I think this election, which has really taken a bit of a backseat over the course of the last couple of months, surprisingly so, given the things at hand here, but with the virus situation, with the economic contraction, politics has taken a backseat away from the fiscal back and forth and negotiations related to fiscal stimulus. But I think as people come back from Labor Day or come back for Labor Day, you're going to start to see a lot more focus on the implications of this election, which I think is going to be one of the most important ones over the past number of years. I think the variance in the platforms is quite meaningful in a Biden-Harris administration. I think it has implications for tax policy and regulatory policy, which historically have been either tailwinds or headwinds for equity markets. And then in addition to that, you've got a series of other issues related to healthcare and the environment, financial policy that are all quite divergent from where the course we're on today.
But Joseph, what's being priced into the markets right now? So I don't know whether there's a belief that actually President Trump, despite the polling, is going to have a second term, or whether there's a discount that actually, if there's a Biden administration, they'll go easier on the taxes than what they've said so far.
I think the market right now is expecting a Biden victory. I think the betting markets and other surveys that I've seen of investors recognize that Biden has a lead today. Certainly there's a lot of time left between now and Election Day. There could be lots of additional data as it relates to the virus and how the economy improves. But I think right now the expectation is for a Biden victory, and increasingly a blue wave. I mean, if you look back over the last, since the beginning of last century, only a couple of new first-term presidents have come in without controlling both houses of Congress. So if you look back over the last number of presidents, they've all controlled both houses of Congress. I think that's going to have some interesting implications for the policy platform. And then in addition to that, there's been an interesting debate that's a bit below the surface right now around the filibuster rule. And that is one of those arcane Senate rules that may change in an administration going forward, and that would allow for more legislation to pass with just a majority. So you wouldn't have the 60-vote majority to overrule a filibuster. So that may allow a lot more legislation to get done than the market expects right now.
Joe, no matter who's in the White House come November, we're going to see an increase in the deficit in the United States at the same time that you're seeing inflation pressures decrease. How concerned are you about Treasuries not acting as the hedge against equity volatility going forward, just based on how low yields are and based on the backdrop here?
I think it's a great point, Lisa. It's a huge issue as we think about asset allocation across fixed income and asset and equity asset classes. Fixed income had always been that ballast in your portfolio that protects it, and with yields at 60, 70 basis points, it just does not provide that. And so that's, I think, it increases. So as you think about the next investment cycle that we're on the advent of, that's going to be an important issue. And I think it will push more asset allocation into areas that offer higher yields that also present higher risk. So you'll see more allocations to high-grade fixed income, for instance, and even high yield in other areas that offer a little bit more yield, emerging market debt, for instance. So treasuries, I think, are going to be at low yields for a long time. I don't know if we're at yield curve control yet, but it seems like we're pretty close.
So do you see, just really quickly here, do you see credit rallying regardless of the fundamentals, regardless of whether we're seeing an increase in bankruptcies and other potholes in the corporate sector?
Well, with the monetary support that the Fed has provided, we think credit's going to continue to be a very good place to invest, and yields over time will continue to contract. So, that level of support, and with an improving economy, which, while we're in fits and starts right now, we do look forward over whether it be the next 12 months or 24 months and expect the economy to be better. And without the alternatives to high grade and high yield credit, I think you're going to see continued demand for that and tightening spreads.
Joseph, thank you so much. Joseph Amato there, Neuberger Berman, President and Chief Investment Officer of Equities. Now, coming up next, we track COVID-19 with Lauren Sauer, Johns Hopkins Assistant Professor of Emergency Medicine. She's coming up shortly, and this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Lauren Sauer, Johns Hopkins University Assistant Professor of Emergency Medicine. Professor Sauer, thank you for joining us once again on Bloomberg Surveillance. There's a lot of talk about a vaccine. Moderna actually coming out with news. We have this Russian vaccine. When are we actually close to a vaccine that will be administered by quite a lot of people around the world?
We have a decent amount of ways to go before we have a vaccine that's ready for everyone. The Moderna announcement yesterday is definitely an exciting step forward with plans with I think it's a $1.5 billion deal with the U.S. for plans to make about 100 million doses, which is fantastic, but they still need to clear that phase 3 hurdle, which is one of the challenges that a lot of vaccines do not get passed, not just coronavirus vaccines, but vaccines more broadly. So we are looking forward to seeing the phase 3 data. That phase 3 has started in several vaccines, including Moderna. Moderna is one of the furthest along. But before we get to that 100 million doses, we have to make sure this mRNA platform works. We have to make sure that the vaccine produces immunity, and that we don't see any of the safety challenges that you could see more broadly with that phase 3.
Lauren, do you have any sense of the rollout of a vaccine, what it would look like, who would get it first, and how it would be distributed?
There's a lot of work being done on that right now. There are groups that have worked on this, not just for coronavirus vaccine, but for many different types of vaccines, especially in emergencies, for a very long time. There's different strategies. We're seeing in other countries a rollout in military first. In the U.S., we would likely see a rollout into vulnerable populations, essential healthcare workers, populations that are of our highest priority to get vaccine into to keep them safe. So there's groups that work on this. I think Operation Warp Speed does have a subgroup working on this as well. And then the priorities will be set after the phase 3, and possibly even within the phase 3, these groups will be prioritized for vaccine access. But definitely we'll look to see healthcare workers among that group.
On Wall Street, there's this sort of conflation that once we get a vaccine, it's just a matter of months or perhaps even less before we get some sort of herd immunity. Is that an accurate characterization given the reluctance of many people to actually get vaccinated, given the Operation Warp Speed, as well as the distribution process?
Yeah, it's definitely not just a couple of months. It'll depend significantly on the trust of the population on the vaccine. So a lot of that will depend on data and the messaging and how we talk to the public about the vaccine. And we're seeing vaccine hesitancy across the U.S. in ways that we haven't seen in quite some time, and that can be really challenging to overcome, particularly with a brand new vaccine and possibly even a brand new platform. We may have a vaccine in the spring that early next year that requires 2 doses, and that may be an additional hurdle where people may not want that second dose or may not be willing to get that second dose. So there's a lot of steps, and that doesn't even account for just the operational plan for distribution. How are you going to access the population? How are you going to set up vaccine distribution sites? How are you going to make sure that you're getting those hard-to-risk populations as well?
Lauren, what can you tell us about, whether immunity, if you've contracted COVID, are you immune? Or again, is that something that we're still trying to figure out? And is that one of the main concerns for the vaccine?
We are still trying to figure that out. That we're in our first phase of people getting COVID. In some of the countries that had COVID cases before us, they're starting to see what happens in people who developed illness, got better, and whether or not they'll develop illness again. We don't know how long immunity lasts. We don't know how long those neutralizing antibodies last in people who have had COVID. We've heard sporadic reports of people getting COVID again, but I think in the spring, we will start to see how long immunity lasts from natural exposure. And then once we have that vaccine in place, we'll have to start to understand how long the vaccine immunity lasts in people as well. It may be that this is a seasonal vaccine, much like the flu, or this may be a one-time vaccine. We'll have to wait and see.
Lauren, thank you so much for the update. Lauren Sauer there of Johns Hopkins University. And be sure to check out VRUS Go on the Bloomberg for the latest information. Now, coming up on Balance of Power, Richard Haas, Council on Foreign Relations President. That's at 12 p.m. in New York, 5 p.m. in London. And this is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revisions.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg Business Flash. Cable giant Liberty Global has agreed to buy Swiss phone carrier Sunrise Communications. The deal has an equity value of about $5.4 billion, and it's aimed at strengthening the company's fiber, cable, and mobile services. Liberty Global is controlled by billionaire John Malone. In Texas, a federal jury ordered Apple to pay Optus Wireless Technology $506 million in patent royalties. The case had to do with 4G technology in the iPhone and other devices. Apple was found to have infringed 5 patents. The company promises to appeal. And it's a move that will make Tesla shares less expensive for the individual investor. The electric car company is splitting its shares in a 5-for-1 exchange. That has the stock rising today. Tesla is up 228% this year. And men's clothing retailer Brooks Brothers has a new owner. The 2-century-old chain has agreed to be bought by Authentic Brands and an entity it owns with mall landlord Simon Property Group. The price, $325 million. Brooks Brothers has 500 locations worldwide. The new owner will keep 125 of them open. And that's your Bloomberg Business Flash. Francine?
Rudica, thank you so much. Now, AB InBev was one of the first global companies to feel the impact of the virus crisis with its large exposure to the Chinese market and a brewery in Wuhan. Well, the beer giant is seeing demand pick up as lockdowns ease and life inches back to normal. The chief executive officer, Carlos Brito, told Bloomberg exclusively that his company learned valuable lessons operating in the pandemic early on.
In Wuhan, we have one of our close to 40 breweries. We have a big operation in China. It's one of our top 5 countries. We have 30,000 colleagues there. And Wuhan, yes, it's a big brewery, but it's one of many. And everything in the country went through a lockdown, a shutdown, consumers, businesses, everything for a month and a half. And then we started reopening. And Wuhan was one of the last breweries to reopen. But now for the past 2 months, everything's back to normal in China as much as it can be. When you look at retailers, bars, restaurants, everything, they're pretty much all open. Our offices are back to normal since 2 months. So China's way ahead of the curve. The same with Korea. South Korea, we have also big business there. And they also experienced COVID as China did in the end of January. And they're all back to the new normal.
So is Wuhan a bellwether for global consumption trends today?
I think we learned a lot in China. I think one of the big advantages of being a global company, and we operate in all continents and have big, business around all the major countries. The big advantage, as you said at the beginning, was that we learned from China early on how to be able to operate, guaranteeing the safety of our people, how to observe and to understand where consumers are going in terms of their consumption, how to adapt our supply chain to the new reality. And when the pandemic started becoming, going to Europe, Africa, the Americas, we had the protocols that were developed in China and South Korea by our colleagues on how to operate. So all we had to do was pretty much translate everything. And because you had to observe social distancing, for example, within the breweries. So you had to operate with fewer people. You had to work from home. You had consumers now not being able to go to bars, restaurants, hotels, or travel. In a lot of occasions, migrating to the in-home occasion. And with that, consumers buying more in supermarkets, grocery stores. And that had a big impact on the supply chain in terms of package mix, brand mix, in terms of delivery, distribution. So agility was something that we learned from China that was very key to navigate, given the fluidity of the situation and uncertainty, because every country was a bit different in how the pandemic developed, in what measures governments took in different countries in terms of lockdowns, stay home type mandates, and how consumers also reacted. But the learning in China was key for us to navigate in Europe, Africa, the Americas.
You've just announced record beer sales. It seems as though people can't wait to start drinking again. What's driving this, and is it sustainable?
It's interesting you asked that, because in China, because it was the first country, the big country of ours that was affected, we did a lot of consumer research during the pandemic. And what we saw is that the question was, what would you like to do once the pandemic is over? And what they told us is that they would love to go back to their normal life. So they'd love to go to restaurants, to travel, to meet their friends physically, to go visit relatives, family members, and do all those sorts of things, go to ball games, go to music festivals. So that gave us a little bit of an insight that, yes, there'll be a new normal, but the fundamental things that consumers are trying to do when they have free time and in trying to keep a close relationship with family and friends are still very much deep inside of them, and we don't think those things will change.
Well, that was the AB InBev Chief Executive, Carlos Brito. Now, U.S. equity futures are actually up. Stocks also up here in Europe. If you look at the bank shares actually rallying in Europe, bond yields climbing globally. Gold rebounding after finding a support below $1,900 an ounce. And we also looked at the VIX index, something that's always important, especially for the month of August. Silver actually halting its sell-off with gold. Investors, again, seem to have decided that for now, the flight from precious metals amid advancing bond yields pound had gone too far. And then I think we should also probably look at pound, given what we saw with the UK economy having one of the worst data points for GDP for the first half of the year in Europe. Now, later today on Balance of Power, Eric Rosengren, Federal Reserve Bank of Boston president. That interview, 12:30 p.m. in New York, 5:30 p.m. in London. They'll talk COVID, they'll talk treasuries. This is Bloomberg.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Can probably continue to grind higher from here as long as we don't have a big negative surprise.
I think we are certainly in the midst of a slow-moving policy mistake.
I've never heard Fed officials basically beg for fiscal policy the way they are now.
Be careful now, because most cycles are probably going to end chaotically.
Every minute that goes by is compounding the losses.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Take a moment to appreciate the sound of silence. Tom Keene's on vacation alongside Lisa Abramowitz. I'm Jonathan Farrow. He'll be back with us next Monday. Lisa Abramowitz in this market about one thing: rotation on, rotation off again. We've seen this movie a few times.
Yeah, this morning, NASDAQ leading the charge after underperforming for the past couple of days, leading to people saying we're going to get this rotation out of growth into value. That rotation seems to be over, John, with today. I wonder, though, if you're still going to get people trying to push that narrative.
Looking at the bond market this morning, yields higher, Lisa, off the back of the PPI data yesterday. CPI today, retail sales Friday. The data gets interesting.
Yeah, we're going to get that CPI data, and we're expecting a little bit of an increase, kind of like what we saw yesterday. It's going to be interesting to see whether we get the same kind of sell-off, a further sell-off in bonds. Also at 1 p.m., we're going to get another record sale of U.S. Treasuries on the long end. U.S. is selling 10-year notes. Yesterday, we saw that 3-year auction come in very strong, yields at record lows. Interesting to see whether that happens again. And then today, we're going to be hearing from the Vice President candidate Kamala Harris after Joe Biden selected her as his running mate. They will be speaking in Delaware later today, John.
Should we get some price action for you, shall we? Let's start with the FX market, shall we? Looking at the euro dollar starting to push just a little bit higher. Euro dollar up 1/3 of 1%. In the equity market this morning, equity futures up by around about 25 points, up by about 3/4 of 1%. But there's the move in the bond market for you. Treasury yields bleeding higher by 3 basis points to 0.67%. Lisa, we did this in early June, where we saw the 10-year get to about 90 basis points. We're not just seeing it in the United States this morning, we're seeing it in Germany too.
Yeah, but it's unclear what's behind that. Is it an inflation bet? Is it a bet that perhaps the Fed won't necessarily buy up as much of the treasuries as possible? Is it a supply issue? John, I just don't see the narrative behind this driving yields substantially higher, and that's going to be a question going forward.
Let's get to the first guest of this morning, shall we? Jared Woodard of Bank of America Securities, head of the Research Investment Committee, joins us right now. Jared, the difference between a sustainable rotation and another head fake. Draw the distinction for us.
Look, we keep it simple here. I think any move to value, any rotation to super cyclical sectors is going to be a tactical short-term flash in the pan until you have some real structural changes in the economy that can broaden out the economic base and provide some real ballast that would move growth meaningfully higher. Until then, I think these are all sort of noisy moves that a lot of investors can ignore.
I'm struggling also because yields are higher. That should be good for the cyclicals. That should be good for the banks. Why is that not another sign, perhaps, of outperformance, given the fact that all things being equal, there isn't necessarily any reason behind this rally?
Well, as you mentioned a moment ago, I mean, there's a lot of cross currents in the bond market right now. There's a lot of confusion about what supply will be like in the future. And I think most importantly of all, the sense that if yields really do rise in a meaningful way, that the Fed will come in with yield curve control and cap any big move anyway. So the long-term benefits, the correlation that you might expect between yields and banks and other cyclical sectors, I think is not going to be what it once was until the economy is structured in a very different way.
You mentioned the financials. That's the problem, isn't it? We saw it in yesterday's session. The financials can outperform on the way down. Can they outperform in an up market, Jared, given the weightings of big tech? Can they?
There's a few things that I think are special about financials that can work. If you start to see deposit growth slow, you start to see loan growth pick up maybe in the later part of this quarter, then I think there are some moves that can happen in financials that are worth taking a peek at. But for a medium or longer term oriented investor, this is a moment in which we're much more concerned that secular stagnation plus epic stimulus equals a really epic bubble in growth stocks in tech and healthcare. We calculated that tech broadly defined plus healthcare accounts now for more than 54% of the market cap of the S&P 500. That's the highest ever. And just incidentally, if you sustain the current pace that we've seen this year, tech and healthcare would account for the entirety of the market by 2024.
Jared, I'd have more faith in a sustainable rotation if we had a deal down in Washington, D.C. We don't. Are you surprised by the calm around that currently?
I am actually. I think that a lot of investors are watching this really closely. They understand that more stimulus is necessary. They understand that $200 a week unemployment insurance is a disaster. $300 is tough. $400 might keep us on the footing that we are at today. But right now we've got none of it. And I think there's a real sense of watching and waiting. And if we go into another week of no progress on talks, then I think you'll start to see the market care a bit more.
All right, care a bit more. How does that translate? In other words, how big of a sell-off could we see if there is no deal after the next week or so?
In September 2008, when the House voted down TARP the first time, you recall, the S&P fell, I think, about 23% in the sessions after that, just for context. I'm not saying we get the same move, this year, but I think that there is a sense in which if it really does look like policy is going to fail, the market can care a lot and care very quickly. So if it may be a scenario in which the market has to impose a little bit of discipline on Washington, and you see a big equity sell-off that sparks finally some level of compromise. We told investors, this week we think it's a Q3, whether it's a hedging risk or a buying opportunity, maybe depends on your time frame. But we wouldn't be surprised if we get a lot more volatility before there's some peace in Washington.
John, I gotta say, what Jared just said there, this idea that perhaps the market will impose some discipline on Washington, goes to something that you said last week with Larry Kudlow, where you said, isn't it problematic that you have so many people losing their jobs at a time when you have markets rallying? Down in Washington, they don't care about the jobless rate as much as they do about what they get in terms of a signal from equities. I mean, you just have to wonder, what does that say about the deliberation process down in Washington,
Well, I think it's embarrassing, Lisa, and Jared, I think you can speak to that as well. If this market was 20% lower, if this equity market was down and down hard like it was in March, I think we'd see some follow-up in Washington, and we don't. Makes me wonder, Jared, for you, what's the cutoff point? What's the point at which you look at things down in Washington and think, it's not happening?
Well, I mean, it's a tough call because our conversations with folks and the sense down there is that everyone involved, basically everyone involved, understands the need for more stimulus, the need for more aid, and they're just sort of haggling about who gets what and who gets credit for pushing things through. A little bit of real stress can overcome some of those challenges. So we do expect that, whether it's a week from now or 2 or 3 weeks from now, at some point we do expect that there will be more stimulus. I guess it's just a question of the path we follow to get there. If on the other hand there was the sense of a different calculation, the calculation that maybe some more economic stress now changes votes for people in November in a way that they think is favorable, that's something to really worry about. So if you started to hear, you will never hear messaging about that, but if you started to have a sense that people are thinking in those terms, then that's something that's a very different market, a very different situation, something you definitely, raise cash on the back of.
Jared, before we let you go, we need to talk about the 60-40 split. It's something that you and the team at Bank of America have been talking about for quite a while. In fact, ahead of the curve in many ways. Plenty more people talking about this now, what to do with the 40 portion. And I just wonder the lessons of the last couple of days, the correlation between treasuries and growth, and more broadly, therefore, the equity market as well. Jared, can you speak to that, the problems there?
Well, look, we wrote this week that the secular stagnation, this economic malaise, has really started to blur the lines between asset classes. In some sense, a long-term treasury bond is not that different from a high-flying tech stock that pays you a tiny dividend. Neither one gives you a positive income stream, adjusted for inflation. And they both start to look really unattractive if we do see a world either of stagflationary populism or a world in which industrial policy and other investments to boost productivity really change the game. And so that's why we suggest investors think not in terms of asset classes as much as in terms of the kinds of risk they want to take. In a world of ample liquidity, that means you can own gold, you can also own things like closed-end funds with a big discount. You can also own credit risk in a way that has less to do with it's designed as a fixed income instrument and more to do with where we are in the cycle and what we see as potential for fundamentals. In any world, those conventional methodologies, conventional ways of allocating assets start to make a little bit less sense. Investors need to be a little more flexible in their thinking.
Jared, gold. A lot of people saying that it could be a hedge against equities, and yet they're moving in tandem. Can you reconcile that?
I'd rather think about gold as a kind of a measure of, in some ways, at this point, policy success. You've got 1.6% inflation. That's a modest recovery. It's not a huge breakout. You've got the Fed on hold. Treasuries yield 0.6% or so. That negative 1% real yield is a kind of a signal from both the bond market and from gold moving in tandem that you can buy basically anything but nominal bonds and you'll be better off. So in that sense, gold is a kind of a get out of here trade from the perspective of the bond markets. And I think that's the signal investors are picking up. You see them rotating not just to gold, but to other speculative things, to SPAC IPOs, to cryptocurrencies, all kinds of assets that otherwise wouldn't make sense if the cost to carry was really meaningful. So to the extent that we get policy success and inflation and growth are able to normalize, then you'll see investors, continue, I think, allocating to things that maybe they wouldn't have done in the past.
Hey, Jared, great to catch up. Our best to the team. Jared Woodard there of Bank of America Securities. Coming up on this program, we'll talk more about the fixed income market with Rob Waldner of Invesco. Lisa Abramowitz on the fixed income market, an adjustment in real yields, just at the epicenter of some of the shifts we've seen cross-asset worldwide in the last couple of days.
Yeah, we're definitely seeing a bleed up in the benchmark 10-year real yield. It's now only negative 0.96%, but leading to questions, is the sell-off in the Treasury market, have it legs, and will it be sustained?
Should we get to some of the price action of this morning? Good morning to you all. Tom Keene on vacation. Yes, Tom Keene on vacation. Those vacation days are racking up for Tom Keene.
Oh.
He texted me this morning at 4 a.m. Shall I come in? Absolutely not. In the bond market, Treasury yield higher by 3 basis points on a 10-year to 0.67%. In foreign exchange, the euro firm at 117.70, up 0.25% now on euro dollar. And equity futures snapping back in a big way. Equity futures up 24 on the S&P. We are positive 0.7%, and we're back on a record high watch. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. China wants to discuss TikTok and WeChat at upcoming trade talks with the US. Bloomberg has learned the Chinese will bring up President Trump's prospective bans on the two apps. The Trump administration has cited national security as the reason. A virtual meeting may take place this week. Joe Biden is counting on Kamala Harris's ties to the American community and her self-branding as a progressive prosecutor. The Democratic presidential candidate made history by selecting the California senator as his running mate. Harris is the first black woman and the first Asian American on a major party presidential ticket. Before being elected to the Senate, she was California's Attorney General. In Hong Kong, media tycoon Jimmy Lai has been released from jail. Lai was arrested Monday, the most prominent figure detained yet under China's sweeping new national security law. It's seen as a sign of how Hong Kong's independent justice system is being undermined. Lai's newspaper, the Apple Daily, is critical of China's Communist Party. The British economy suffered more than any other major European nation during the coronavirus lockdowns. It shrank more than 20% in the second quarter from the previous 3 months. That followed a 2.2% drop in the first quarter, and it officially pushed the UK into its first recession since 2009. And Airbnb is going public. Bloomberg has learned the home-sharing startup plans to file paperwork for a stock market listing in the next few weeks. Shares could start trading as soon as the fourth quarter. Airbnb's business has rebounded after being hammered by the coronavirus lockdown. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Reasons that surprised me, she was probably nastier than even Pocahontas to Joe Biden. She was very disrespectful to Joe Biden, and it's hard to pick somebody that's that disrespectful.
The President of the United States weighing in as the former VP, Joe Biden, completes his VP pick in Kamala Harris. Kevin's already joining us just a moment. Let's get to the price action first of all, though. Shaping up as follows this morning. Equity futures up by 25 on the S&P 500, up by 0.75%. In a bond market, yields high by 3 basis points on 10s to 0.67%. The euro with a lift 117.72. It's just the Treasury market this week, Lisa. We had a 3-year supply yesterday. I think you mentioned 10-year supply today and 30 years tomorrow.
What's interesting is that even though we're getting record auctions, we're getting record low yields. So it doesn't sort of hamper the U.S.'s ability to borrow unprecedented amounts of money. I do wonder, though, John, how much the supply is factoring into the sell-off that we're seeing in treasuries right now, exceeding any increase in expectations for inflation.
We'll talk about that a little bit later with Rob Waldner of Invesco. Joining us now from Washington, D.C., Bloomberg's Kevin Cirilli, our chief Washington correspondent. Kevin, in many ways, it's historic. In many ways, it's also safe. Can you speak to that, the former VP's VP pick?
Precisely. And in fact, on a range of different policy issues, Jonathan, she is worlds apart from Vice President Mike Pence. And when they do get up on that debate stage in the next couple of weeks, it will be remarkable to see the contrast. On foreign policy, she has advocated to rejoin the Iran nuclear disarmament deal, something this administration has said should be thrown out the window. On energy policy, she has advocated for the framework of the Green New Deal, something that this administration has said is a non-starter with them. And then on domestic issues pertaining to fiscal stimulus, she has advocated that certain families that earn less than $140,000 a year, that they be able to have $2,000 per month during the remainder of the pandemic. That is something that we're still at an impasse here in Washington, D.C. on. But from a broader standpoint, whether it's social issues or whether it's to your point about the glass ceiling that she could very much shatter, Senator Kamala Harris, the junior Democratic senator from California, is really poised to electrify the base of the Democratic Party. But she does it at a time in which there are challenges on the campaign trail because of the pandemic.
Kevin, we know what the playbook was for the administration. It was to basically paint this ticket as a Trojan horse for the radical left. I'm not sure how effective that's going to be with Senator Harris on the ticket.
Well, she has really crafted her political message as a bridge of sorts between the far left of the party as well as the centrist wing of the Democratic Party. And she is a generational bridge as well. She now is at the forefront of a next era of Democratic Party leaders, regardless of the outcome on November 3rd. But to your point precisely about that type of attack, she is also someone who during the presidential primary the crowded Democratic presidential primary, really took it head on the issue of health care, where she at one point had been a co-sponsor for Senator Bernie Sanders' Medicare for All plan, and then put out a plan of her own that allowed for there to be some type of private option to be included in the health care debate. I think, but on the issue of the middle of the road, as it relates to something like China, for example, a close examination of her record, she has sponsored legislation that would make it easier for the United States to go after officials in China who steal U.S. intellectual property. And I mention that and I bring that up because you're absolutely correct. She has worked with Republicans on certain issues like China. She actually worked with Senator Mike Lee on immigration on a wonkier issue. But so she does have somewhat of a bipartisan streak in her record as well.
I would just have to say, Kevin, the fact that this is a generational shift for a person who is 55 years old really indicates what something about the leadership in the United States Congress. I will say, just going forward, how much will she actually cater to the undecided votes, given the fact that she also is going to, as you say, energize the base?
So we talked about the policy. Now let's talk about the politics, because when I was talking with Democrats and Republican strategists all throughout the last night since this has happened, how will Senator Harris play in Wisconsin, in Michigan, in Pennsylvania, in Scranton, the presumptive Democratic presidential nominee Joe Biden's hometown? How will she play in those battleground areas? And we don't know. This is someone who came to Washington, Lisa, with that political it factor, right? And whether it was then Senator Barack Obama or Senator Marco Rubio, certain senators arrive in the upper chamber with that type of political it factor. And she always had that about the future of her political ambitions. She loves to campaign. I've covered her out on the campaign trail. I've covered her in the upper chamber. She loves to campaign. Now we're in a situation where there's virtual conventions, where there's no pomp and circumstance. We are anticipating a joint appearance sometime later today or over the next couple of days, but there won't be the confetti. There won't be any of that pomp and circumstance. So how she's able to navigate that through the Zooms, through the Skypes, through the other video conferencing, it will be interesting to see, because quite frankly, when you talk to her team, when you talk to the Biden world, she wants to get out there and do the selfie lines. But right now, that's really not,
Kevin,
that's not
at
an
least
option.
she's got the energy for the interviews.
Yeah.
I mean, let's face it. This is what the senator brings to the table, right? It's the energy. It's precisely what the former VP does not have compared to what he's up against.
Well, and I think, I'm looking at this in terms of from today until November 3rd, and you've got 3 debates. You've got the vice presidential debate. You really could not have more of a contrast on the policy, on the politics, and quite frankly, the personality between Vice President Mike Pence and Senator Harris. Last night, because I'm a political junkie nerd, I rewatched the debate between Tim Kaine and Vice President Mike Pence. And Tim Kaine is a very different debater than Senator Harris, And,
I mean it politely, Kevin. Tim who? That was how uninspiring that pick was.
But you look at, and then, you rewatch the way Senator Harris in the Democratic debate took on Biden, took on Tulsi Gabbard. I mean, it's going to be really interesting to see. And Joe Biden knows how important this pick is. I mean, if you want a safe pick, I mean, she does have some unpredictability in her record and in her campaign style, good or bad, but there is that element there. And Jonathan, just the final point that I would note on this, remember, Joe Biden debated Sarah Palin. So he knows exactly the type of attacks that the Republicans are already set to be trying to drum up when you've got the president re-election campaign already debuting that nickname, phony
Hold on
Kamala.
a second. John, did Kevin just conflate Sarah Palin with Mike Pence? Is this sort of a comparison? Are they analogous? Is that what we're talking about here?
No.
Okay.
Let me
just
be crystal
be
clear.
clear about that.
What I'm saying is, I'll be very clear. What I'm saying is that Joe Biden knows how important vice presidential debates are because of his history when he was on Barack Obama's ticket, and so there's that. And then also, Vice President Pence has always used a more steady, stoic debating style in this entire first term, in a rather unpredictable type of President Trump administration. And yeah, so that's what that was the
Why
point.
Why are you bullying Kevin this morning?
Well, Tom's not here, so someone's got to do it.
Kevin, great to catch up with you, sir. For the market, it was about one thing. It's who it wasn't. It was not Senator Warren. From New York City this morning, good morning. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio alongside Lisa Bravitz. I'm Jonathan Ferro. Tom Keene, back with us in a few days. He'll be back on Monday. I understand he is moving. He's in the middle of a move right now. Lisa, it's not a vacation. I should characterize it a little bit more specifically. He is moving up a single floor.
Yeah, evidently that's incredibly difficult. Actually, I can testify that it is. I will say, I think he also might be selling some of that jewelry that he bought in a rush
To fund the move
Yes.
up a single floor. People think I'm kidding. This is the truth. This is why he's off for the next 3 days. Tom's moving apartment. He's going to the floor above him. He can tell you all about it on Monday. Let's get to the price action this Wednesday, shall we? Good morning to you all. We bounced back on the equity market, up 25 on the S&P. We advanced 0.75% in the FX market. A euro 117.64. Euro dollar coming back just a little bit, still off that 119 level we'd reached in the last week or so. In the bond market, this is where the action's been. The activity yields up by 2 or 3 basis points this morning to 0.67%.
Okay, ladies and gentlemen, I'm placing a stop on profit for British pound. All my positions will be closed if price will reach 132.67. So 1, 2, 3, 4, 5 positions will be closed at this price if the price will reach this level. Okay.
Invesco Chief Fixed Income Strategist and Head of Multi-Sector Strategy. Rob joins us right now. Great to see you, Rob, as always. Any evidence of some jitters around the August supply?
Yeah, great to see you, and thanks for having me. You know, as you pointed out, bond yields have risen in the last couple of days, and we are getting supply now. But I think the more important thing here is that we're starting to see some signs of growth continuing, the recovery continuing. And, you know, importantly, Jonathan, we're starting to see, you know, sort of a peak of infections in the U.S. So total daily infections have peaked. We see countries like Sweden show a fairly substantial decline in infections. And I think the market's just sort of looking through this and wondering, we got the vaccine news, potential vaccine news yesterday, wondering whether this recovery might have more legs than it originally anticipated.
Well, Rob, many people going back to early June, that was the last time the rotation trade really petered out. And what we saw in the bond market topped out at about 90-odd basis points on a 10-year in early June and faded it. Many people will be looking at this move in the last couple of days and wondering whether they should fade that too. What do you tell them?
I think that the action is really going to be in real yield. So I think, you know, the other important thing that's going on here, Jonathan, is that the Fed is really committing itself to this kind of long-term inflation averaging policy. And what that means, we think, is that'll come with, essentially that comes with a sort of aggressive forward guidance to say, hey, the Fed's not going to do anything for quite a bit of time. And so that will sort of peg the short end of the yield curve and should put a bit of a cap on the top end of where yields can go. So they might go higher, but we're not expecting a massive spike higher. And we'd really look in real yields, where probably the action should be for a continued rally in real yields. So if you want to fade this market, I'd fade it in real yields.
Rally in real yields, does that mean that they're going to go more negative?
Yeah, that could go more negative. That's right.
How low? How negative can 10-year real yields go?
Well, you know, I think 10-year real yields could, they're just about 1% right now. You know, I think we could probably see 10-year real yields, you know, go another 20 to 30 basis points lower, at least if inflation expectations pick up to, you know, historically where they've been, because people buy into what the Fed is saying, somewhere close to 2%, you could see, you know, real yields 30 to 50 basis points lower than they are now.
So basically, another way of expressing this is investors will see inflation ticking up over the longer term, yet they'll still buy bonds even at these very low yields because they are believing in that Fed backstop. What do you do as a fixed income investor if you're basically losing money investing in treasuries? Where do you go to hedge against this dynamic?
Well, so the option in fixed income is credit, and you know we do like credit assets because the same factor, the Fed committing to staying easy and to this sort of long-term inflation averaging means that they will not be preemptive in raising rates. And if you look as a credit investor, one of the things that's really hurt you in the past is the Fed being aggressive in raising rates. So you look at 2018, you look at 2013 with a taper tantrum, you look at 2004. All of these periods, you know, you got the Fed raising rates or threatening to raise rates, and that caused a kind of correction in risk markets. So if the Fed is not going to be aggressive in sort of preempting inflation increases, that is relatively positive for credit. So you know, we still you know, look for credit investments to do well.
Rob, I keep asking this question, and I hope you give me a good answer. What would lead to wider spreads? What would it take? What would you need to see?
Here, right now, you know, the liquidity at the current time, Jonathan, the technicals are so incredibly positive. You have all this sort of preliminary funding has been done by corporates, a very aggressive new issue calendar. That new issuance has dropped off. You saw companies draw their lines down. You've seen a tremendous amount of credit put into the system. So there's the technicals are very, very positive right now for credit markets.
I think we've already had a record August, Lisa, for high yield supply. Just checking the date, it's August 12th. I mean, we've already had a record August, and we're not even 2 weeks into the month. Supply, Lisa, just hasn't rolled off in the way people thought it would coming into the summer.
No, you've even seen dividend recapitalization deals. You've seen increasingly speculative deals. And I'm just wondering, Rob, at what point do you push back? I mean, given the fact that we saw a can maker sell bonds, sell 10-year junk bonds at the lowest ever yields, a sub 3% yield, is this indicating that perhaps things have gotten ahead of themselves and you're not necessarily getting any return for the extra risk you're taking?
Well, so valuations are tight, right? I mean, valuations are inside of their long-term averages, so inside their 10-year averages, but not a tremendous amount inside their long-term averages. And we've been concentrating much more on the high-grade market. So looking at high-grade supply, versus where we were in sort of March, April, the supply numbers have really come off quite a bit. Some estimates would even put, high-grade supply, net supply, to be potentially negative this summer. So, the valuations are certainly tight, but they're not that far inside 10-year averages. So, there still is spread to be had there in the credit market.
All right, so there still is spread. This is a point that John's been making a lot, and this is an important one, the idea that even though absolute yields are at record lows, you are seeing higher spreads, higher extra yields over benchmark rates that are above the longer-term average pre-crisis. I'm wondering, from your perspective, though, how much investors have to lower their returns expectations for credit? What is prudent in order to get the return they're expecting rather than a whole lot of potholes as they face bankruptcy?
Well, with the government bank, government yields real yields being negative, you have to revise down your return expectations, right? And they're negative pretty much across the board. So you do have to revise down return expectations. And we would, our view is to continue to concentrate on higher quality assets that are not impacted at all by any potential, renewal of the, slowing. Where those spreads are just inside of long-term averages, but we're not, Lisa, we're not advocating taking a lot of risk here. As I said last time I joined you, with valuations tight here, even with technicals positive, you have to be somewhat cautious.
The average 10-year yield in G10 right now, do you know what it is? Exante Data put this together. Jens Nordvig did this. 0.2% is the average 10-year yield in G10. That's 20 basis points, Rob. I'm sure it might have changed in the last couple of days off the back of this sell-off. Is that what we're pricing off here? The average 10-year yield, which is just at ridiculous historical lows?
That's what we're pricing off. And the average real yield is negative. So, that is what we're pricing off of. If you are going to get negative real returns in the risk-free asset, if you like, you will have to take it. You have to take.
So then, Rob, you can't just play for income. You've got to play for total return. And most people are looking to get a little bit more aggressive as well. You said play it safe. I've heard that from so many fixed income investors. If you play it safe from here, that capital, what's it going to earn?
Well, of course, you get, John, that you get yield in fixed income. You also get, your roll and your carry, and you can get a continued tightening of spreads because we are still, as I said, just inside the long-term averages. So you can get total returns that are higher than the yield. And, that's what we kind of think you'll get over the next 6 months.
Rob, great to catch up. Always a good sport. Rob Walden there of Invesco on this bond market. Lisa, you mentioned spreads. Can you imagine at the start of the year, I think it was the middle of the year, high yield spreads were just north of 300 basis points. If I told you the economic data points for the rest of 2020, would you have told me that going into the back end of summer would be at 475 on US high yield spreads? I doubt it.
No, I mean, nobody could understand this heading into this year because it was unprecedented, the move that the Federal Reserve took, the idea that they bought, they're going to backstop lower rated investment grade credit and higher rated high yield debt. And I have to say, if you look at the rally in BBB rated credit, it just blows me away. I'm sorry. And I know Kevin
Lisa,
watches.
No, but this is the issue, Lisa. I can tell you the data, but you can't tell me what the market's going to do with it because the data alone is not sufficient to come up with a trade. You need to understand the policy. I want to ask a very basic question of credit investors like Rob and others as well. It's not picking on Rob Walden of Invesco. What would it take to get wider spreads and no one can really give an answer because of the Fed's presence in this market.
Yes, although you are seeing discretion. You are seeing, for example, the CCC sector underperform. That's the lowest rated sector underperform. You're seeing specific names continue to lag behind the broader rally. You saw people trying to hide out in the higher quality junk debt. So I wonder, John, at what point you see capitulation on that front, because people are still trying to have some modicum of control over their risk impulse given the Fed's backstop. And perhaps that's where you can see the data playing into it.
I've got to say, you've been very restrained the last couple of days, not calling this market a bubble, Lisa.
I mean, honestly,
I'm impressed.
How can you call it a bubble? You could have called it a bubble 5 years ago, right? I mean, it's highly influenced by Federal Reserve policy. It's highly influenced by the incredible amount of liquidity sloshing around. I mean, you can call it a bubble, but it can keep blowing.
Changed, Lisa.
I've changed. I'm not the same Lisa you once knew.
You've changed.
Well,
in
am
the
I
last
wrong?
couple of days. I'm not saying
changed?
you're wrong.
I mean,
I'm just saying you've changed.
It could be a bubble. I'm just not going to be the one to call it.
Should we get to the price action of this morning? Good morning to you all. This Wednesday morning, we shape up as follows. In around about 50 minutes, we'll get you some CPI data for the bond market. Treasury's lower for a fourth straight session ever since the payrolls report. Yields bleeding higher, up another 3 basis points on 10s this morning to 0.6. Let's call it 7% there, 0.67. In the FX market, euro dollar 117.62, up 0.2%. And there's your bounce back in equities. Equity futures, a nice bid to them, up 22 on the S&P 500. We are positive 0.66%. From New York, alongside Lisa Abramowitz, I'm Jonathan Ferro, with Tom Keane away for the next several days. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Joe Biden and Kamala Harris will appear together in a virtual fundraiser today. It's their first appearance since the Democratic presidential candidate made the California senator his running mate. Harris is the first black woman and the first Asian American on a major party presidential ticket. State officials concerned about slower than normal mail delivery are extending mail-in ballot deadlines. They're also making backup plans to smooth early voting in the weeks before the election. Still, experts warn that tens of thousands of ballots might be thrown out. The Postmaster General, who was appointed by President Trump, is being blamed for slower service. The Postal Service says it's working with election officials. The U.S. government has reached a deal with another potential maker of coronavirus vaccine. Moderna will supply 100 million doses of its experimental shot in an agreement valued at up to $1.5 billion. The company already is getting $955 million in government aid to test the vaccine. And in New Zealand, the city of Auckland is back in a 3-day lockdown. That's after the country's first local coronavirus cases were discovered in 102 days. Authorities are now trying to trace the infections. New Zealand wants to avoid what happened in Australia, Japan, and Vietnam. Those countries had early success in fighting the virus, but now they see it coming back. And it's a move that will make Tesla shares less expensive for the individual investor. The electric car company is splitting its shares in a 5-for-1 exchange. That has the stock rising today. Tesla is up 228% this year alone. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
we are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it, that makes me confident that we are going to do everything we can to determine safety.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
I think for some currencies, it could be a little bit of a race to the bottom. Nobody particularly wants a strong currency when there's no inflation.
The wonderful Jane Foley of Rabobank, the head of FX strategy, straight out of London, the capital of global foreign exchange. Let's get to the price action this Wednesday morning, shaping up as follows. Equities with a bounce back, a lift. We move higher by 23 on the S&P 500, up 0.7%. In foreign exchange, the dollar weaker against the euro. Euro dollar 117.60. It's a mild move, up 0.2%. In the bond market, fourth session of softer, lower, weaker treasuries. Yields higher, up 3 basis points on a 10-year to 0.67%. And here's the stock move at the moment. It is the only moment this morning I will mention it, because whenever I talk about this stock, I just get the hate mail. It's Tesla, up 6.5%. The why, I don't know if the why really matters given what it's done this year.
Yes, it matters.
A 5-for-1 stock split, Lisa. I mean, let's stop talking about Tesla for a moment. Leave that to one side. I can't handle the hate mail around this company.
I'm going to have to mention this again. Carry on.
But stock splits and adding value to companies, I mean, technically, Lisa, they shouldn't. We saw this with Apple. I imagine we'll see it with more as well. It's meant to democratize the access somehow.
Okay.
I don't get it.
All right, listen. There is this idea that you can already buy a share of a share. You can buy a portion of a share, so it shouldn't really matter how expensive each share is. And yet it does, because if you think about it, there is some sort of, even if it's philosophical, this idea of just owning a share of something. And Tesla, I'm going to mention it, caters to retail investors. I mean, if you look at Robinhood accounts, Tesla is such a huge portion of what people are going after. They want to make themselves more accessible to that individual trader and say, look, we're more, men of the people kind of idea.
And
I mean, that's the idea.
You're up 229% year to date. Congratulations. There's just no need to be so vicious about it to everyone that hasn't been.
Scarred. This is somebody who is scarred by the feedback.
I just don't get it. I just don't get it. Equity futures this morning up about 23, up 0.7% on the S&P 500. In the commodity market, big breakdown in gold and precious metals in the last 24 hours. Let's get straight to Harry Chilangarian, shall we? BNP Paribas head of commodity market strategy. Harry, great to catch up with you, mate. Let's talk about it. What happened in the last couple of days?
I think first and foremost, gold has reached another historical high, and the question eventually was going to be when will people be taking profits? But I guess more fundamentally, what we're looking at BNP Paribas is the leveling off in break-even inflation rates. So that's sort of stabilizing negative real rates at where they're at right now. And that sort of removes one factor of support for gold. And then on top of that, you start adding investor flows into silver, which is a sort of cheaper alternative than hedging your macro risk. Then you could see the consolidation that's taken place.
Harry, yesterday's sell-off in gold, really violent. I mean, considering the fact that there weren't similar kinds of violent moves elsewhere. It was the biggest sell-off since April of 2013. Does this indicate a positioning squeeze, something about the nature of this trade that gives you pause about how much higher gold can go?
Well, currently, in our view, again, trying to link gold to the sort of macroeconomic fundamentals, we really watch closely what U.S. real rates are doing. So with the nominals being relatively flattish, it's a question of, did it still have the fuel to move higher? And oftentimes when you reach a historical peak and you have this kind of acceleration in prices, the correction could be quite important. Now, given that U.S. real rates on a 5-year basis are still at negative 1.23%, there is support from a macro perspective for gold to hold on to its recent gains. So we're thinking about gold trading in the 1900s, 1950, thereabouts, before potentially having another rally next year.
Okay,
But fundamentally, it's still good.
Okay, so another rally next year. Tom Keene took the day off to go buy some more jewelry. For Mrs. Keene to invest in gold, how much higher could we see the price go in the next heel of this, in the next leg of this rally?
Well, we're viewing in our forecast of BNP Paribas the next leg coming in Q1 next year, especially as we see realized inflation year on year benefiting from base effects, which would help that famous break-even inflation measure move higher. Understanding that the Fed is going to keep yields really low, potentially even adopt yield curve control. And so on that basis, with those break-evens moving higher and nominals remaining pretty much where they are, you get that further impetus for gold to successfully move above 2,000 again.
Harry, are you having new conversations, different conversations with a different pool of investors that maybe you weren't having back in 2011? Is there a new angle to this gold trade that wasn't there about 10 years ago?
I suppose, and you guys were mentioning it, there's a lot of retail interest that's happening. That I don't talk to retail investors, but there's certainly a big shift in terms of retail interest, even Robinhood investors looking at gold. But I think more prosaically, you have a number of institutional investors that are looking at gold as a very good macro hedge. Because equity valuations being sky high, if you do have a correction there as a result of disappointing economic outcome tied to the evolution of COVID, then gold's there to hedge your portfolio.
Harry, how effective do you think that will be, given the positive correlation between gold and growth stocks at the moment? How effective do you think it will be as a hedge?
Well, the hedge comes in really if you take losses on the equity side, then you will sell that gold portfolio, which obviously has seen a very big increase in price, so as to mitigate the losses you have elsewhere. That's really its primary function.
Harry, great to catch up with you, as always. Really good to see you. Harry Chinangarin there of BNP Paribas on what is happening with this gold market. Lisa, things have broken down in the last 24 hours, but I think the new conversation, the new angle, and Harry was talking about it, is the hedge, the replacement of treasuries in the portfolio with something like gold, and we've heard that several times, in fact more than that,
but
in the last month.
You asked the right question, which is how effective is that going to be? Because what we've also seen is that gold has traded very much in tandem with equities. So at some point, you see one or the other, and at some point, people will say, well, longer term, perhaps it will act as a hedge. Really, are we seeing the same kind of demand on the physical investors, or is this really a speculative trade by Wall Street?
Well, it offers you that inverse correlation, but it offers you an inverse correlation to something very specific. It's the cyclical parts of the equity market and not the growth parts of the equity market that dominate the index like the S&P 500. That's where things get a little bit tough for me, Lisa. And I think Joe Weisenthal of Bloomberg talked about this in the last 24 hours on Twitter as well. How effective will it be if growth makes up so much of the overall index and it correlates positively to something like gold?
That's a good question. I also am struggling to understand how leveraged positioning is, how quickly you could see a sell-off gather steam, as we saw yesterday, based on the fact that you've got certain quant funds and others trying to use this as a financial hedge. And I wonder whether the infrastructure around gold trading is substantial enough to withstand the potential volatility.
Should we get to the price action of this morning? Again, just for a quick update for our audience worldwide on Bloomberg TV and radio. This is how we shape up this morning. Up 0.7% on the S&P, positive 23 points on the S&P 500, bouncing back from yesterday's sell-off. In foreign exchange, the euro a little bit firmer, stronger, higher to 117.60, up by 0.2%. And this has been the move that's got everyone's attention, the move in treasuries. Real yields starting to inflect just a little bit higher off the lows of the last year or so. In fact, going back several years, nominal yields inflecting higher over the last 4 sessions too. Yields up 3 basis points this Wednesday morning to 0.67% from New York. This is Bloomberg Surveillance.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging. we feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Markets can probably continue to grind higher from here as long as we don't have a big negative surprise.
I think we are certainly in the midst of a slow-moving policy mistake.
I've never heard Fed officials basically beg for fiscal policy the way they are now.
Be careful now because most cycles are probably going to end chaotically.
Every minute that goes by is compounding the losses.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning to the second hour of Bloomberg Surveillance live on Bloomberg TV and radio, 1 hour. Interruption-free. It's almost jarring. I expect someone to be coughing and clearing their throat at the top of the hour, and it's just not happening. It'll be back Monday if you're missing that on Bloomberg Radio and TV. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Price action really fascinating. Tom actually dropped me a message this morning, Lisa. He was itching to come back, at about 4 a.m., looking at the price action. And this rotation that we've seen, I think it's got everyone's attention. We've had head fake after head fake. Is it real this time around? And I've just been confronted with loads of doubts in the last 24 hours.
Yeah, and every investor that we speak to says buy any dip, buy the big tech stocks on any dip whatsoever. We got a little bit of a dip yesterday, perhaps, compared to the S&P and the day before, and now people are going back into them. You have to wonder what it would take to make people truly believe in the cyclical story. That has to come from the data. The data just isn't there, John.
I think you've got to believe that you get a sustainable lift in Treasury yields, Lisa. And to your point, that takes more than supply. That takes real economic data and real improvement. And that's where the Dow stalled in early June. I think it's a hard push to say what there will be reinvigorated at any point in the next couple of weeks, Lisa.
Yeah, I will also say that the reason why Tom Keene was messaging you at 4 a.m. is because he doesn't want to actually move up one floor. Look, if I had to move, I also would be procrastinating and saying,
people
please.
think we're joking about this.
No, I'm not.
About where Tom is. Tom has really moved up a single floor, and that's where he will be for the next 3 days. Moving boxes. So the mood that he will be in on Monday, I look forward to that. The price action this Wednesday morning shaping up as follows. Let's start with the equity market and get you up to speed worldwide. Cross asset, we look like this. Equities up 0.7% on the S&P. Positive 23 points, looking good this Wednesday morning. In the FX market, euro dollar 117.69, up 0.25%. And in the bond market, up 2-3 basis points on a 10-year to 0.67%. 27 minutes and about 27 seconds away from CPI in the United States. We'll bring you that data point and catch up with Bloomberg's Michael McKee a little bit later this morning. Joining us now, straight out of London, James Bevan, CCLA Chief Investment Officer. James, great to hear your voice, sir, so let's get straight back to it. Is this rotation a head fake or something more sustainable?
I certainly think that equities will grind higher because I absolutely believe that the Federal Reserve and the Treasury will continue to provide liquidity, and that has got to be good news for the quality growth companies that have been taking the market ever higher. However, I would sound two notes of caution. One was the market reaction to the news from Russia yesterday that they had found a vaccine for COVID-19. Now, although it was early stage, the market's initial reaction, I thought, was really interesting because what we saw was that the big tech stocks sold off while bank stocks rallied. It was also the case that precious metal prices dipped and bond yields rose. And I think this is a real taster of what will happen if the COVID-19 crisis passes by. But equally, I worry that investors have been very undiscriminating in terms of what they have been prepared to buy in this liquidity-driven melt-up. It is the case that we can make sensible investment decisions on quality stocks. And if you press me for where the S&P 500 might finish this year and next year, I wouldn't be at all surprised, given where bond yields are, that we don't get to 3,500 this year and 3,800 next year.
Wow.
But the villain of the piece, I think, is distressed debt, because when I look at the default volumes in Q2, that came in at $41.1 billion. Now that is in comparison with the previous record of $39.5 billion set back in 2009. Now, whilst liquidity can stop markets ending up in a credit crunch, they can't provide companies in trouble with cash flow. And sooner or later, those companies will be found out. And that's why I think it's so important to look through to what's really going on at the company's level, whether it's achieving sufficient revenues to justify its long-term access to the capital markets.
So, in other words, an argument for active management. I want to stick on this idea of liquidity versus solvency, liquidity versus the recovery story. It seems to be, me, that you believe in a further rally in equities, and yet you're saying it's going to remain a liquidity story, albeit with perhaps some progress on the virus front. How much can remain a liquidity story to sustain this type of rally? In other words, can it just be concentrated in the big tech names, have them drive the stock market higher with this idea that they will stay solvent through this, even if you have those bankruptcies increase? Or do you expect there to be sort of some rotation to sustain that going forward?
Well, what I find very interesting is how many people, when challenged as to where equity markets are going for, talk about mean reversion to long-term averages. And the story I hear often is that the forward price earnings multiple for the S&P 500 as an index is currently over 22 times. The average since 1960 is 15 times, and therefore, on that simple basis, equity markets are due a very substantial mark down. However, that argument forgets what's happened to bond yields, and bond yields have been cratered in the way that we have described, and therefore we can justify a much higher valuation for the equity market. And if one is going to think about the fair valuation of equity based on a company's return on equity, cost of equity, and growth, then actually the tech stocks still, in my view, look reasonably good value. I don't think this is the right moment to give up on quality growth. I worry that there are plenty of people talking about companies with high operational and financial gearing benefiting from a cyclical upturn. I just don't see that happening, and therefore I think that's a really dangerous strategy to follow.
James, you've raised a really important point. In fact, a couple. So let's get to the first one. That's on benchmarking valuations through history. Can we just sit there for a moment, James? What's the effective way of doing that?
Well, I think if you're going to look at history, you've got to be very clear about which portion of history you want to look at. And I would say that the really important issue is to look at the connection between bond yields and valuations, and therefore, by extension, the equity risk premium. So the forward return for taking equity risk relative to the current bond yield. And I would say there, we are still looking at equities being cheap, and hence my expectation that we can get to 3,500 for the S&P 500 for the end of the year. The story goes horribly wrong if bond yields rise very dramatically and that there is a sell-off in global treasuries. But I don't see central banks and governments permitting that to happen, because to get rid of the real cost of the debt overhang that is now round the necks of the global economic participants, there has to be a period where inflation is considerably in excess of nominal bond yields, so that the real value of that debt is run down. So for me, the obvious long-term losers are the bondholders. The obvious long-term winners are investors in good quality companies, so long as they buy a decent free cash flow that's sustained.
Well, James, this assumes they can control the yield curve. So let's assume they can, particularly here in the United States. Yep. Haven't they just fixed the equity game then? Doesn't that mean financials cannot work in this regime?
Well, you know, interestingly, when I think about financials, I would say two things. One is that we should not anticipate that the Treasury yield curve and the pricing of debt in the marketplace are one and the same. I mean, I am absolutely aware that there are companies issuing debt in the marketplace at yields that frankly look way too low for the riskiness that they represent to investors. But nevertheless, there are record deals going through in the bond markets at sensible prices, where banks, if they replicate those yields in loans to customers, will be able to make sensible returns. The other part is that I think that there will be some real winners and yet some real losers within the banking sector. So I think that the muscularity of JP Morgan will mean that they will grow market share. They will come out of this with more pricing power. They have made some very significant acquisitions, as we know, in recent years, and I don't think that they have driven the efficiency gains of those acquisitions through to shareholder value as of yet. So I am a bull of JPM.
You're a bull of JP Morgan. I want to look forward a couple of months when we start talking about the election. I'm old enough to remember we weren't talking about the virus and we weren't talking about the worst recession since the Great Depression, and we were talking about trade tensions and tensions in general. This Saturday, the U.S. and China are going to talk about the Phase 1 trade deal. They're going to assess the progress. China is still very much behind. How much does this factor into your trading at all? I mean, is this a tradable event or factor into your investment theses, or is this just basically more sort of smoke on both sides leading to some protracted Cold War that's already in existence?
No, I think it's a really important point, and I would say one of the reasons for the dollar's weakness is the global concern that the U.S. may turn the current debate about the current account, so trade, into a debate about what happens on the capital account. And I would observe that people are of the view that trade tariffs simply hurt consumers, because if you're a Chinese company exporting to the States, you get your money for the product. We all know that the China government has been subsidizing exports. But the loser then is the consumer, who has to pay more when the tariff is applied. On the capital account front, I think that Team Trump recognized that China has a huge demand for global capital. Huge chunks of the cash generated by U.S. quantitative easing ended up in China. I guess not many people have joined the dots, but that's the reality of the credit flows to China. And the U.S. is clearly going to look at this. And I think that one of the things that we can observe is that there has been very considerable borrowing of dollars outside of the U.S., which has depressed the value of the U.S. dollar. And were we to see either an end to the aggravation that has been escalating between China and the U.S., or actually an outright decision, so the uncertainty is removed on what will happen on the capital account, the dollar has room to rally. So I'm not of the school of thought that the dollar is one way and one way only, being down. And nor am I of the view that the RMB, China's currency, has any chance of becoming a global reserve currency.
Hey, James, great to catch up. Wide-ranging interview there. James
Wonderful
Bevan.
to speak with you.
Good to hear from you, sir. You sound safe and well, too. That makes me happy. James Bevan of CCLA. Coming up on this program on politics down in Washington, Jeffrey Wright, Eurasia Group U.S. analyst from New York City. A beautiful one this morning. Futures up 24 on the S&P. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Joe Biden is counting on Kamala Harris's ties to the African-American community and her self-branding as a progressive prosecutor. The Democratic presidential candidate made history by selecting the California senator as his running mate. Harris is the first black woman and the first Asian American on a major party presidential ticket. Before being elected to the Senate, she was California's Attorney General. China wants to discuss TikTok and WeChat at upcoming trade talks with the U.S. Bloomberg has learned the Chinese will bring up President Trump's prospective bans on the two apps. The Trump administration has cited national security as the reason. A virtual meeting may take place this week. Billionaire media mogul Sumner Redstone has died. He was 97. Redstone turned his father's drive-in theater chain into a media empire. He was the controlling shareholder of Viacom CBS. Redstone has been in failing health for some time. It's a move that will make Tesla shares less expensive for the individual investor. The electric car company is splitting its shares in a 5-for-1 exchange. That has stopped rising today. Tesla is up 228% this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
There's no disputing that some of the actions that the Trump administration have taken on China were long overdue. It's just back to the how they're doing this.
Dan Tannenbaum of Oliver Wyman on the tension between the United States and China. That tension will bleed into the weekend as both sides sit down for virtual talks on the progress of a phase one trade deal. The latest in the last 24 hours, we're reporting that China wants to bring up WeChat and TikTok in that particular conversation. We'll be interested to see whether those lines get blurred in the coming days. For the price action this morning, positive. Risk appetite improves. Equities higher on the S&P 500 by around about 23 points, up 0.7%. Rotation on, rotation off. It's been the story we've followed over the last couple of months. In the bond market, yield higher by 3 basis points. This puts a nice bid into the financials. Switch up the board and get to JP Morgan. JP Morgan bid for 5 straight sessions coming into Wednesday. This morning, we're up another 1.7%. Lisa, we are still down on the year by more than 25%. But certainly treasuries and the move we're seeing in the last few days are giving these bank stocks a bit of a lift.
Yeah, just a little bit of perspective. So JP Morgan shares up without even today's rally, up about almost 9% in the past week. And you're seeing something similar for Citigroup, up 7%. And you go down the banks, and they're basically ranked in order of size. And that's how big their returns are. The biggest are getting the biggest boon from the higher yields. Interesting to see how long this can last, though, John.
Lisa, I imagine in the last 24 hours, if a certain Senator Warren became the VP pick, that maybe banks wouldn't look like that this morning. Is that fair to say?
I think that might be fair to say, but she wasn't, so that's not the case.
Well, let's take the conversation in that direction. Jeffrey Wright joining us now, Eurasia Group US analyst. Jeffrey, Kamala Harris getting the VP pick. I just wonder for enthusiasm, which is what former VP Joe Biden has been criticized for, that he lacks the enthusiasm in his base that maybe the current president Donald Trump has. Does this do anything to make inroads there?
It may help a bit. I think it probably helps somewhat with African-American Democrats, who are a very important constituency for the party. But I think in general, President Trump is going to bring all the enthusiasm for Democrats. I think as the campaign really kicks into gear, as you saw in the 2018 midterms, you know, the negative partisanship, the feelings of hatred that Trump inspires in the Democratic base, that's going to be, I think, enough motivation. And so Harris is really a pick to do no harm. She's a pretty safe pick, and I think you start with somebody who's not going to hurt you, and she certainly does that.
All right. Well, given the fact that she's a safe pick and she's in line with where Joe Biden was going, or that it seems to be the party line, what does that mean in terms of the U.S.'s international policy? And I say this ahead of trade discussions between the U.S. and China, an increasing hardline from President Trump that President Trump will probably be campaigning on. How different will it be in the Democratic candidate?
I don't think Harris's selection changes much there. Trump has tried to attack Biden over China. It's been, I think, tough sledding for them so far because the only thing that voters really care about right now is the coronavirus and the economy. And so, Harris, I think, comes with, some political help for the ticket. I don't think she brings a whole lot of policy heft or changes to the places that Biden was already in on policy. And particularly on foreign policy, Biden has a very well-developed operation from his years in the Senate and his time as vice president. So I think her influence on foreign policy is probably going to be pretty small. Maybe on some domestic policy areas you see her impact.
All right, let's go to the domestic policy then. We really don't have any kind of agreement. In fact, we've got stalemate in Washington, D.C. when it comes to the second round of fiscal support, even as we have an unemployment rate that seems to be stabilizing here above that 10% rate. Do voters in general, from what you can tell, view President Trump as doing the right thing and winning this round in the stalemate with Democrats, or do you see increasing ambivalence about which party has the better plan here economically?
Yeah, I don't think that voters in general are paying close enough attention to understand the sort of machinations going on in Congress. I think basically the longer they go without a deal, the more it hurts Trump. It's generally a very simple equation. The incumbent is on the hook for the economy, whether that's fair or not. I mean, you could say that Democrats are holding out, but ultimately Trump owns the economy, and the longer it goes without additional fiscal support, the more severe this sort of mini downturn is going to be, I think. So I think regardless of who blames who for what, Trump is on the hook here because he's the president. He owns the economy, for better or worse.
Jeffrey, do you still assume that we get a deal done in Washington before the end of the month?
Yeah, we maybe not before the end of this month. I think there's a good chance now that it stretches into September, but I do think we get a deal before the end of September, before the government funding deadline, which provides sort of another forcing mechanism for Congress.
What are the signposts that you're looking for that might change your calculation and say, there's a chance here we won't get a deal? Because everyone we're speaking to still assumes deal. Maybe at the end of the month, maybe at some point in September, but deal and something around $1.5 trillion. What would change that for you, Jeff?
I think if Trump decides that he doesn't want a deal anymore, which is, I think possible, I think that move would be against his own political interests because he really needs fiscal support for the economy right now. But, we've seen him make moves in the past that were not in his own interests. And it's possible that he gets so frustrated with Pelosi and Schumer and the way that they've tried to handle this negotiation that he walks away from it. I think that's the most plausible way that you don't get a deal.
Jeffrey, great to catch up. As always, our best of the team. Jeffrey right there of Eurasia Group. Special coverage of the Democratic Convention starting Monday night on Bloomberg TV and on radio as well. And then the week after, of course, the Republican Convention kicking off. Full coverage of that as well. And Lisa in the mix right now. We just can't get round a table and have a conversation, never mind striking a deal down on Capitol Hill.
And you said it really well. Wall Street expects a deal. I'm trying to understand here. People are saying there's going to be a deal. A deal in September is not the same thing in a deal in 2 weeks. There is a material pain the longer this goes on. There are people who cannot make their bills, and you have to think at some point Wall Street will start pricing in, or markets will start pricing in even a late deal, which will have economic consequences, Sean. I mean, this is a nuance, but it's an important one.
I'm not sure if Wall Street's following this right now. Maybe it needs to show up in the economic data, but I don't see any sign of this showing up in the equity market at the moment whatsoever. The president made his announcement over the weekend. You might have expected a little bit of chaos on Capitol Hill and some tension in the market Monday morning. Didn't really happen, Lisa.
The faith is that they will come to some sort of deal again, and everybody says that. I believe it. The issue is, how do you even quantify how much more economic damage is done each week that goes by?
And I think Kathy Jones at Charles Schwab put it nicely. The policy mistake is being made. The deadline effectively was the end of July. And here we are in the middle of August having the same conversation, Lisa, with very little urgency whatsoever from either side at the moment.
People are saying that the Federal Reserve is going to come in and just do more if federal policymakers do less, if fiscal policy doesn't come in. And that seems to be the bet that we're seeing with some of the higher quality names continuing to rally.
Helps the market. Does it help the economy? That's the story. Coming up on this program, Anna Han, Wells Fargo Securities equity strategist on this market, and Michael McKee on the economic data. US CPI, that print is 4 minutes and around about 21 seconds away. We'll bring you the data live on Bloomberg TV and radio, and the price action as well, with equity futures up almost 24 points on the S&P 500. We advance 0.7%. This is Bloomberg Surveillance.
De esta manera me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en una 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio. Tom Keene is away for the next couple of days. He'll be back on Monday. Alongside Lisa Ravitz, I'm Jonathan Ferro with your economic data in the United States. Here's Mike McKee.
All right, thank you, John. We're looking at the Consumer Price Index. Month over month comes in double what had been anticipated, up 0.6%. Now, that is the performance similar to what we saw in the PPI yesterday. Ex-food and energy also a 0.6 rise. In that case, we were only expecting a 0.2 rise. Pushes the year-over-year numbers to 1% for the CPI headline number, and that's up from 0.6%. So a significant jump in the last month. The core rate goes up to 1.6% from 1.2%. Again, a significant increase over the past month. Taking a look at the breakdown of some of the numbers, the gasoline index accounted for about a quarter of the monthly increase in the headline number, up 2.5% for energy itself. Gasoline 5.6%. Food decreased 0.4%, and food at home down 1.1%, maybe reflecting the fact that more people were able to go out for lunch and dinner to restaurants. The other number that everybody wants to watch on a regular basis is housing. And let's take a look here. The Rent of Primary Residence Index, which is the CPI equivalent of home ownership, up 0.2%. That follows a 1/10 gain last month. We'd had a string of 0.3 gains. It does suggest that home prices may be falling a little bit. Maybe at least the price increase is being arrested. We're certainly seeing that in the New York area. And so it may mean that combined with lower mortgage rates, we're going to see a lot more housing activity. We saw the Mortgage Bankers Association numbers jump this morning as we hit new record lows on mortgage rates. So it looks like we're not going to see a major increase in inflation, but we are seeing it move very quickly. And that is one reason we're seeing break-evens on the 5- and 10-year note rise very quickly. We're seeing 5-year break-evens, and hopefully we have the chart here showing that they're up significantly compared to where inflation is. There's a debate in the markets, and Lisa knows more about this than I do, about whether this simply reflects the Fed pinning the short end or whether people are actually believing that we're going to get an outbreak of inflation, guys.
Mike, stay close. I just want to whip through the price action outside of what you were talking about. Looking at equities, a delayed reaction. We roll over just a little bit. Still positive on the day by 19 points on the S&P 500, up around about 0.5%. Outside of equities, into the bond market, Treasury yields with a lift going into the number, a lift coming out of it too, up by almost 5 basis points on a 10-year to just about 0.69%. That's your 10-year. Even the 2-year yield, just with the smallest of moves, up about a basis point. Outside of that, if we can get to foreign exchange, the euro still firmer on the day to 117.62, up about 0.2% on the session. Mike McKee, people will take this report. They'll do exactly what you did, go through the individual components, work out what's giving it a lift, and then they'll ask themselves a simple question. What's sustainable? What's a one-off shock? What lasts? What lives with us through year end into 21? How would you respond to those questions, Mike?
Well, right now it looks like what we're getting back to is a little bit more of normal in terms of pricing, given the fact that the economy has opened up a little bit. You see a rise in used car trucks and prices, 2.3%. That was a significant increase, one of the outliers in this report other than gasoline. And it reflects the idea that people are now buying again, but maybe not buying new cars at the same rate that they used to because the economy is running a little bit more slowly. But when you look at the interest rate reaction here, I'm looking at the 5-year breaking its 50-day moving average up to 31 basis points, basically. You're seeing people repricing for a little bit more normal. The question is, do they believe this continues, and do we run into supply shortages down the road that will keep prices rising, or are we just normalizing after a period of unusual weakness?
Yeah, and the 10-year yield also breaking out, as Sean was mentioning, now up to close to 0.69%. Mike, I find it interesting that you have yields rising and you have stocks selling off slightly, rolling over, not selling off completely, but giving up some of the gains in pre-market trading. Does this indicate a stagflationary bet that basically people are saying higher prices are just going to reduce the buying power of consumers and not necessarily indicate faster growth ahead? Or does this indicate that the economy is recovering in a meaningful way that will benefit the average consumer?
Well, it's hard to tell from 1 month's data, and we did see a little bit of a rise last month as well, but the anecdotal information is that the economy is running a little bit more slowly than it was in early June, say. So it's going to be an open question on Wall Street for a little while until we get some more specific data. Retail sales coming up, that'll be important in Wall Street's mind to see whether this is a reflection of stronger growth or whether it does imply that there might be some stagflation down the road. We haven't had that since the 1970s. I'm not sure it's coming back, but it is going to be a question for investors for a couple of weeks while we wait to see how the other half, the growth side of this equation, comes out.
Michael McKee. Mike, always great to see you, sir. Mike will be back with us a little bit later this morning to pour through this economic data. Let's get to the price action, shall we? A little under 1 hour away from the opening bow this Wednesday morning, with equity futures up 22, still advancing 0.7%. In the FX market, dollar weaker against the euro dollar 117.72, and there's your Treasury move lower, yields higher by 4 basis points on a 10-year to almost 0.69%. Just last Tuesday at the close, we had a close just north of 50 basis points, so quite an unwind in the Treasury market over the last week or so, and not just nominal yields, real yields too, with a little bit of a lift again this Wednesday morning. Let's continue the conversation, shall we, with Anna Han, Wells Fargo Securities equity strategist. Anna, great to catch up with you. Let's start with a simple one. I wonder whether we are overestimating Europe's recovery and underestimating what is happening here in the United States. What's your take?
Well, we saw Europe kind of be one of the first areas to fall with the COVID crisis. And usually we're of the belief that first in, first out. But what they didn't have necessarily was the size and the depth of the monetary and the fiscal stimulus.
As you can see, we closed all our positions on British pound at 132.67. All positions are closed.
It doesn't look like this week, and it's unclear when exactly the Republicans and Democrats will get together.
Well, yeah, we sort of missed the deadline this time, right, before the summer recess has started. But what we do know is we have another deficit or a budget deficit plan that's going to be due at the end of September. And towards that fall, as we get closer to the U.S. elections, it's going to become a big indicator of how the economy is going to go forward and what things are going to shake out for equities in particular.
Anna, what do you look at? What data to give you confidence that there is some sort of continuing recovery and not this stalling out that a lot of people were talking about when they were looking at the high-frequency data?
Well, I think you have to acknowledge that we are seeing some stalling. It's been a bit slower since, let's say, late June and July, but we are seeing far from a reversal. And as we get that sequentially improved story in indicators, for example, like in earnings, or you see even with investor confidence, weakened from before, maybe a month ago, but still much better than we were in the winter. Those are the signs that things are progressing slowly but forward.
Are you comfortable embracing cyclicality?
At this point, we're still risk on, John. We do think that cyclicality, in particular with its COVID beta, will be the winning play longer term. But that's not to say that this melt-up doesn't have us a little more cautious than usual.
What are the cyclical parts of this equity market, Anna, that you would be uncomfortable with? Just breaking it down from sector to sector if you can.
Well, when you dig in really sector to sector, where you think about cyclicality and where value may be uncomfortable is where is the traps? Where are the areas of the market where they look like they're cheap, but they're not going to have that multiple expansion as rapidly or as easily as you would suspect? And for now, what's been a difficult spot for us is probably the financials market. A lot to do with also the suppressed yields.
The financials, the banks, and low yields, which are going to be here with us for a long time. Anna, great to catch up with you. Anna Han, Wells Fargo Securities equity strategist. Let's get to the price action this morning, shall we? Inflation coming in a little bit hotter than expected on CPI. This is what it does for the market. Not a whole lot given where we were going into the print. Yields are up by 4 basis points on a 10-year to 0.68%. In foreign exchange, the euro firmer, a lift here. Euro dollar up 0.4% to 117.87. And in equity futures, up 0.8%, positive 26 points. We talked a little bit about JP Morgan earlier. James Bevan of CCLA, likes the stock. The stock is down by about 25% and change year to date so far, but we have had a lift, Lisa, over the last 5 days. And the why? Well, the why is in the bond market.
Yeah, the why is in the bond market, given the fact that there is no alternative, and that does seem to be the ongoing narrative here. I am looking at the inflation-adjusted data. I'm looking at TIPS right now, and it looks like real yields are actually going a little bit lower than where they were earlier today. I'm just trying to understand how people look at this inflation data and decide whether it is a good sign, whether it means that it's good for the economy, or whether it's a bad sign and it means that people's purchasing power is declining. And that is sort of a key struggle underpinning some of the data. Are we just seeing a stabilization in an economy that is still highly injured, or are we seeing something that's going back towards something a little more normal?
Well, it's good if people are spending. If people are out there spending, that's good news. If it's supply shocks, I would argue that's bad news, especially at a time, Lisa, when we don't have the support on the fiscal level that a lot of people would like to see, a much bigger effort down in Washington, D.C. And I take your point from around about an hour ago on whether we've already made the policy mistake down in Washington. Now, you can characterize whether you think it's a policy mistake or not. Maybe you think what is happening down in Washington, D.C. is the right thing. What we can all agree on is it will have consequences. Just look at the GDP print out of the UK this morning. An ugly, ugly quarter. Quarter on quarter, not annualized, negative 20%. Lisa Bram, it's negative 20% for the second quarter. And the unemployment rate, what's the unemployment rate? It is 3.9%. Why? Because there is unprecedented fiscal support that is basically paying people to stay at home in a furlough program. That furlough program expires in October. What the UK offers you is a case study of how you can carry on supporting people at home when they can't get a job. And what we're going to see in the next few months as that fiscal support comes off, the consequences, and the consequences will be there to see in the economic data.
This is such a strange recession, and I'm struck by the calm before the storm that seems to be underpinning a lot of the commentary. Yesterday, Moody's Investor Service put out a report talking about how delinquencies among consumer debt has actually come down year over year, and how they expect a rapid increase in delinquencies going forward as some of the government stimulus comes off. That's the unknown, and that's why we've seen such a big build of money put aside by the big banks for bad debt.
Coming up on this program, looking forward to catching up with Angelo Zeno, CFRA, Senior Equity Analyst. We'll do that next right here on Bloomberg TV and radio. In your market, we are positive 0.8% on the S&P 500. From New York this morning, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Joe Biden and Kamala Harris will appear together in a virtual fundraiser today. It's their first appearance since the Democratic presidential candidate made the California senator his running mate. Harris is the first black woman and first Asian American on a major party presidential ticket. State officials concerned about slower than normal mail delivery are extending mail-in ballot deadlines. They're also making backup plans to smooth early voting in the weeks before the election. Still, experts warn that tens of thousands of ballots might be thrown out. The Postmaster General, who was appointed by President Trump, is being blamed for slower service. The Postal Service says it's working with election officials. The stimulus stalemate drags on, and the principals in the negotiations to get a new virus relief package haven't spoken since Friday. The White House says Democrats must reduce their demands for $600 a week in unemployment relief and for aid to state and local governments. Democrats say Republicans must put another $1 trillion on the table. That's in addition to their original $1 trillion offer. The U.S. government has reached a deal with another potential maker of coronavirus vaccine. Moderna will supply 100 million doses of its experimental shot in an agreement valued at up to $1.5 billion. The company already is getting $955 million in government aid to test the vaccine. And billionaire Sumner Redstone has died. Redstone was a movie theater operator who became a media mogul late in life by buying Viacom, Paramount Pictures, and CBS. He controlled his assets through his closely held National Amusements. Ownership in that company will pass to a family trust. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Sometimes you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
This is now life and death. We are talking about a lapse in benefits that is already triggering food insecurity, homelessness, and it's not going to be repaired anytime soon.
The brilliant Diane Swank there, Grant Thornton, chief economist, speaking to us in the last 24 hours on this economy. Coming up shortly on Bloomberg TV, looking forward to catching up with Priya Misra, head of rate strategy for TD Securities, on a 4 or 5 day sell-off for the Treasury market, Lisa. We have been lower since Friday.
She is the perfect person to talk to also about the incredible amount of supply coming from the U.S. Treasury with another 10-year note sale today. I will be looking forward to that, John, and listening to that interview. Right now, I want to shift to after the bell today. We're going to be getting earnings from Lyft following the worse than expected earnings from Uber. Joining us now to talk about it is Angelo Zeno, CFRA Senior Equity Analyst. What are you expecting today after the bell with respect to Lyft?
Yeah, so thanks for having me. So as far as Lyft is concerned, we'll kind of be looking at three things here. First and foremost, kind of any trajectory or clarity on the actual ride-sharing recovery here within the U.S. Most people are aware that Lyft clearly more leverage to the U.S. relative to Uber, and any kind of clarity on that side of things would definitely be helpful. Given what we've heard from Uber last week, clearly it seems like the trajectory is still very low, and I'd say kind of no longer expecting a hockey stick type recovery in that market. Second, kind of looking at what type of OPEX improvements they're making. If we can kind of see any type of clarity in terms of adjusted EBITDA profitability in the future, that clearly is kind of what investors care most about. And if we can kind of get any type of clarity on that side of things, I think that'll be important. And then finally, commentary about the gig economy in California, of course. Some important news this week coming out But, all eyes, coming this fall with the election and Proposition 22, any commentary they have on that side of things, I think also will be critical in terms of the performance of the shares.
There's a lot in there. Let's unpack a little bit of it. I want to just start more broadly with the ride-sharing industry, and we have seen it thrown into turmoil as a result of COVID, this question of whether the drivers will be safe, of whether riders will be safe, and whether everyone just wants their own car. Going forward, how much does this pandemic fundamentally change the outlook for the sharing economy in general and the ride-sharing industry more specifically?
Yeah, I think a lot of people out there are underestimating the potential long-term permanent implications this will have on the overall industry. The fact that there are going to be a lot more people working from home. In terms of a lot of the airport traffic, which is definitely a higher ASP and margin type of business, we do think that eventually recovers steadily in 2021. It's about 10 to 15% of their revenue. But as far as some of that work from home impact, we think long term, some of the numbers we saw in terms of ride sharing market, we think longer term we're looking at about 75 to 80% of the numbers that you maybe have seen in terms of recent peak quarters, and that's really going to have a long-standing impact on what the potential here is for a profitability perspective here.
So why do you have a buy rating on Uber?
So we have a buy recommendation on Uber because we do expect to see a recovery on the ride sharing side of things, but of course we think investors are actually underestimating the actual potential in terms of the Eats side of things. We think the acquisition of Corner Shop as well as the Postmates acquisition, we think will definitely help in terms of that side. So if anyone is actually looking to play a recovery on the ride sharing side of things, I think Uber provides some sort of cushion in case things were to not evolve the way they were supposed to. But I think the actual potential long term for Uber, plus the actual valuation along with the cash balance they have there, they'll be able to navigate this storm very well. I would also say that when you look at protracted downturns like this, often the strong get stronger and the weak get weaker, and this is going to have a much longer lasting impact on the negative side of things for Lyft, and it could actually help Uber long term.
Uber shares right now at $31.21. That's where they closed yesterday. Where do you see them going?
So in terms of Uber, we think over the next 12 months, as long as we see a gradual recovery, we do see, we think the shares could gravitate towards $36 per share. Clearly Proposition 22 is going to have a major impact here in terms of the actual outlook on.
Well, as you can see, I showed you all profit and loss. We closed all positions on British pound. So this is how it works, basically. Okay?
We've seen really, we think, at the end of the day, if Proposition 22 doesn't come to pass, and eventually if Uber and Lyft are forced to treat California drivers as employees rather than independent contractors, ultimately we think that Uber and Lyft will both look to pass a lot of those higher costs to the consumer. That'll likely result in less employed drivers. It reduces the supply of the network, and that's of course the revenue potential of these companies. So ultimately, we think it ends up being a loss not only for these companies but also for a lot of jobs out there. So it's I think a lot of people out there have to look at the implications here, but clearly it's definitely a negative in terms of not only the cost side of things but also the revenue potential for both of these companies. I'd say as far as Uber is concerned, less than 10% of their revenue goes into California, so that's a nice little hedge relative to Lyft, where we think over 20% of the revenue is currently going into California.
Angela, just to finish up here, I'm wondering whether you ever think that meal delivery will be a profitable business, given the promise and the fact that it did actually contribute to Uber's bottom line this past quarter.
Yeah, no, we actually do. We're a lot more bullish about Uber Eats today than we were just 2 quarters ago. Clearly the pandemic has had huge implications from that side of things. But I think they've also been able to kind of look at the potential opportunities in terms of corner shop, grocery shopping, and other ways of delivery in terms of kind of the Eats side of things. So, we remain very optimistic in terms of the Eats business. And, I think, we kind of look here over the next kind of 24 months, and I think you have the potential for adjusted EBITDA profitability on that side of things as they scale the business.
Angelo Zeno, thank you so much for being with us, CFRA Senior Equity Analyst. We are expecting those lift earnings after the bell. Just want to bring you up to speed on what we're seeing in the markets following that bigger than expected inflation read, the consumer price index rising 0.6% versus a 0.3% expected. We're seeing an interesting rotation back to the cyclical trade with the S&P futures once again outperforming the NASDAQ. We see a lift to Treasury yields, continuing that trend, that sell-off ahead of the $38 billion auction of U.S. 10-year Treasuries later today. That is at 1 p.m. Gold actually now up after yesterday having its worst sell-off since April 2013. Coming up, Balance of Power, Eric Rosengren, Federal Reserve Bank of Boston president from New York. This is Bloomberg Surveillance.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City for our viewers worldwide, good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures doing nicely, up 25 on the S&P. We begin with the big issue, rotation on, rotation off. Investors facing a familiar question, whether to leave the big equity market winners behind and embrace the cyclical losers. Patrick Armstrong of Plurimi Wealth saying stay defensive.
I prefer quality and growth over cyclical companies. Cyclical companies have had a big rebound on the fiscal spend over the last few days, but I think long-term winning strategy remains the year-to-date winners over the last week's winners.
Chris Harvey of Wells Fargo embracing cyclicality.
If you look at a lot of cyclicals in the United States, they are multinational. And if you look at valuation, if you look at balance sheets, they are very good. The things that are really contrarian opportunities, to things that are tied to the economy, things that are more value, are the things that are really mispriced at this juncture.
There is one risk at the epicenter of this trade, this conversation. Fiscal talks on Capitol Hill going absolutely nowhere. Senate Majority Leader Mitch McConnell conceding we're at a stalemate. Quote, there hasn't been a meeting of any consequence between the two parties since last Friday. That's too long. It's time to sit down and get a deal done. From Washington, Bloomberg's Kevin Cerulli joins us right now. Kevin, no talks on the agenda for today, tomorrow? Walk me through it.
No talks. And in fact, just as I was talking yesterday with some sources on just how far apart Democrats and Republicans are on this impasse, they're about $2.5 trillion apart. Even if a lowball estimate is $2 trillion, that's still the size of Apple. I mean, they are, as one source put it, they are a world apart in terms of ideologically, in terms of the price tag, in terms of even looming battles that lie ahead for big pharmaceutical companies once a vaccine is ultimately in development. Look no further than the presumptive Democratic presidential nominee Joe Biden's vice presidential pick, Senator Kamala Harris, a Democrat from California. She has argued, along with the other House Democrats, including Speaker of the House Pelosi, that families that earn less than $140,000 a year annually ought to be given $2,000 per month until the pandemic ends. So just right there, shortly before a U.S. presidential election, shortly before contentious Senate elections, all of this is the background to an increasingly divisive debate. And quite honestly, while Wall Street continues to expect there to be more stimulus, that is what I still hear from my sources on both sides of the aisle.
Kevin,
that more stimulus is likely going to come.
I hear it on Wall Street as well, that we'll get a deal, it'll be $1.5 trillion, it's going to happen. It's going to happen, and here we are in the middle of August hearing the same thing. It's going to happen. I imagine when you woke up this morning, it wasn't about stimulus talks, though. It's all about the former VP making his VP pick. What's the reaction in the nation's capital?
Well, 3 quick points that I would make. First and foremost, she represents a bridge of sorts between the progressive wing and the centrist wing of the Democratic Party on a host of different issues pertaining to Medicare for all, as well as a Green New Deal and re-entry into the Iran nuclear disarmament deal. All of that is a sharp contrast to Republicans and President Trump's re-election efforts. Secondly, as it relates to China, she's much more in the common ground middle, so to speak, or consensus rather, not middle, consensus between the left and the right. She's introduced legislation, bipartisan, that would allow for the U.S. to go to pursue individuals in China who sue or who steal, rather, intellectual property from the United States. And lastly, she is a historic pick. She would be a glass ceiling shattering vice president, and what she represents is a sharp contrast in every which way from the current occupant, Vice President Mike Pence. So that debate is going to be fascinating when they debate each other.
I have to say, the VP debates just got a little bit more interesting, didn't they, Kevin? You mentioned China. Let's just get there very quickly. There will be talks at some point this week. I'm not sure on the date, the time, but it's going to happen into the weekend between China and the United States on progress of the Phase 1 deal. This government has kept this track completely separate from everything else. The trade channel insulated. The Chinese, as we understand, are looking to bring WeChat and TikTok into the conversation. Kevin, how does that change the calculus, the conversation this week?
It doesn't. I mean, look, there's a consensus on China in terms of U.S. and China policies. Look at how India, I think that's a pretty good preview, I'm told, in terms of the steps that the United States could take as it relates to China. On the issue of Huawei, I think that they're, based upon my reporting, and I talk to sources who tell me that you could see a further extension and ramp up domestically of the U.S. trying to separate more domestic companies from Huawei. And then on the issue of Tencent, I mean, you talk about WeChat, you talk about some of these games. But Tencent really is the wiggle room, so to speak, that the administration has left open. It was by design that there's some market confusion as to whether or not it's just WeChat or a business doing with Tencent as a whole. And so that likely is a geopolitical bargaining chip that could come up in the talks that the Chinese want to have with the United States over the next couple of days.
Kevin, some quiet down on Capitol Hill. Get some rest, sir. That's the first time I've said that to you in quite a while. Kevin Cirilli down in Washington, D.C. And your equity market here in New York City, equity's doing nicely, up 26 on the S&P 500, positive 0.8%. On this program last Friday, we had that conversation with the administration. If this equity market was 20% lower, I think it's embarrassing, it's unnerving, but I believe, and I'm sure many people do as well, that we would get a deal done much quicker if this market was moving. Right now, it's just positive. We're just going higher all over again. Here's the take from BDIG's Julian Emanuel, writing the following. Are legislators being lulled into inaction by the social media barrage lauding the Nasdaq's new all-time highs? If so, it is the same Nasdaq 100, which has shown a large loss of momentum in recent days as the US dollar strengthens and gold plunges back below $2,000. Julian joins us right now. Julian, is there a connection here between what's happening in the equity market and what isn't happening down in DC?
There is a connection, John. Basically, you know, when you saw the action yesterday, I mean, for a number of weeks now, we've had the momentum trade start to slow. Behind the scenes, the NASDAQ has lost momentum, you know, as that rotation, which we actually believe will continue into cyclicals, into value, into international markets. But frankly, when you look at it, there's only so far that the market itself can go without the stimulus, because as you rightly pointed out, the market is still pricing in somewhere between $1 trillion and $1.5 trillion. And what we found out yesterday and what we're discovering this morning is that there are no new talks scheduled for another several days. And part of the narrative is if the market holds in here, you know, there is less of an urgency to these talks, but that is why we think you saw the reaction that you did yesterday.
Julian, to be clear here, you don't think we can get a durable cyclical rotation without a broader, bigger fiscal deal down in Washington?
You absolutely need it. There's no question about it. Look, factually, if you think about it, and again, obviously the virus is in the backdrop of all of this, is that when you've reached the peak in the northeastern states earlier this spring, that's when you started to see cyclicals outperform. When you reached or are reaching the peak in the southern states and California, et cetera, over the last week or two, that's when you've started to see cyclicals outperform. But the risk is, as we all know, and as you know, the football conferences showed yesterday, by virtue of the Big Ten and the Pac-12 postponing the fall sports season, is that the risk is the virus, you know, is still with us. And so that package is absolutely vital to bridge the time between now and when we get a medical solution, presumably in the first half of 2021.
Julian, over the last couple of days, do you think we've confused just a momentum correction, a correction in the momentum that we've seen across several asset classes, with a rotation, the beginning of something else?
Well, it's difficult not to confuse it, John, because the violence, particularly in something like gold, and the reality is, and you've talked a lot about this in recent days, is that the incredibly low level of real yields has been part and parcel of the NASDAQ outperformance, of the dollar weakness, of the gold rally. And as that is starting to moderate and in some cases reverse, the inclination in a world where there's still tons and tons of liquidity is to look for something else, which is why you're seeing this cyclical rotation. But again, you need outside policy to continue it on this course.
Julian, there's something you've said in your research in the last couple of days that is new: mispricing uncertainty, and some of the trades that accompany that view from you. Can you just walk me through it, and specifically on the change and why you have changed your view?
Absolutely. If, you know, simplistically put, it's the level of the VIX. Our thesis for really much of the last 2.5 years is that we were operating in a more volatile environment for a number of reasons, politically, geopolitically, really very many reasons. And as we looked at it, we actually haven't suggested option strategies since February, where we advised clients to be paying for options because we felt that, essentially when you peaked at over 80 in the VIX and even coming down, through 30 and into the 20s, that options were overpriced. What we think is the case now is that options are attractive down here around VIX 21, 22, particularly heading into what is typically the most volatile part of the year, September. So whether you're looking to hedge exposures or amplify or shift your portfolio around, we think options really make a lot of sense now.
So Julian, let's talk about it. What's the objective for you? Are you trying to capture upside? What are you trying to do?
Well, you're trying to stay invested with, again, shifting cyclically, but, in something like financials, clearly there's been a huge amount of volatility under the surface in the financial sector as yields and the yield curve itself have ebbed and flown. And, obviously the yield curve is steepening now, and that's been part of the positive for financials. But really what options allow you to do is ride out some of that volatility while maintaining your core position on the one hand, but on the other hand, with something like NASDAQ, where we do see the potential for both relative and absolute underperformance, hedges make sense to us.
Julian, do you think if the NASDAQ corrects and cyclicals start to outperform, that we can get an up market on the S&P 500? What we've seen in the last couple of days, clearly, the financials can outperform in a down market. Can they do the same in an up market on the S&P?
Well, we think they can, and we think they ultimately will. The issue as it stands right now is that you've had such huge NASDAQ outperformance, specifically concentrated in, the 5 FANG names, is that this concentration at 23% of the S&P 500 index has made the weighting so high that if those names actually decline in an absolute sense, it will be difficult for financials to lead the broader market higher. And I think that's part of what we saw yesterday. But ultimately, we think whether it's time or price in terms of correction, and we lean towards further price erosion in the NASDAQ in the near term, that you're going to get to a point where the more cyclical themes will durably be able to lead further upside.
Julian, great to see you. Send my best to the family. Thanks for your time this morning. Julian Emmanuel there of BTIG. Coming up on this program, Treasury yields higher this morning. Once again, we've been higher every day since Friday after the payrolls report. This, after inflation comes in, a little bit hotter. Up next, Priya Misra of TD Securities from New York City this morning. Good morning. With equity futures pushing higher on the S&P 500. We're up. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data
is, of course, it has slowed, but the good news is that it is continuing, and it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
There's that feeling that, now is the time to hedge for a larger inflationary situation down the road. The transition into a truly high inflation environment, I think, would take a political dislocation of Fed leadership that could be a risk for the future, but it's not a reality in the near term.
MCAM's Mike Dada watching for inflationary pressures in the months ahead. This is CPI data tops estimates for the month of July. For more, let's bring in Bloomberg's Mike McKee. Hey, Mike.
Good morning, John. Yeah, inflation both at the headline and core level for the CPI coming in double what had been forecast. The core jump, the biggest since January of 1991, both of them up 0.6%. That pushes the annual rate to 1% for headline and 1.6% for core. A jump like this naturally going to raise questions about an inflationary breakout. Mike Dada raising those questions even beforehand. Some talking of stagflation coming back. You look at inflation break-evens, they had been rising even before today's numbers. They jump on the numbers today. Market rates also immediately reacting. But aside from the usual caveats about 1 month's data, a couple of points. In February, before the pandemic shut the economy, headline inflation was 2.3% and core 2.4%. What went up this time? Well, gasoline, 5.6%, the biggest mover. Used cars, 2.3%. Airfares, 5.4%. That's a percentage jump off a very low number. And car insurance, up 9.3%. Those are not the things that you would look to if you were experiencing a broad-based inflation breakout, not a category that signals necessarily trouble ahead. Home prices were up just 0.2. That's a slowing from the 0.3% we were getting sort of month after month, and may suggest that housing affordability is going up. And the biggest decline came in food prices. They were down 0.4 overall. Food at home down 1.1%. So while we don't have a widespread breakout in inflation, we had some specific categories that go up significantly. We probably can't say that deflation is off the table. Later today, we'll be talking with Boston Fed President Eric Rosengren, and we'll get his take on this whole idea of an inflation breakout, particularly given the talk that the Fed might want to let inflation run a little hot for a while.
Looking forward to that conversation a little bit later on Bloomberg TV and radio with Michael McKee. Mike, thank you, sir. In the bond market right now, Treasury yields higher for a fourth straight session on a 10-year. We're up by about 4 basis points to 0.68%. TD Securities expecting a pullback in Treasuries to be short-lived, right in the following. The rise in rates has been driven by supply. We're fading it. The virus is still raging, the recovery has stalled, and there's some big risk factors with the Phase 4 deal and U.S. election. TD's Priya Misra joins us right now. Priya, is that all it is for you then? Supply jitters this week, 3-year yesterday, 10s today, 30s tomorrow?
Yes, I think so. And, we had been sort of coiling in this very narrow range, 50 to 55 basis points on the 10-year. So there wasn't really any setup. And as we heard from Treasury, tons of supply, long end duration supply. So I think the market's setting up for it. Yesterday's 3-year auction went well. I think the setup actually bodes very well for the 10-year and the 30-year. So I think once the auction's out of the way, you look ahead and then you realize all the same risk factors that were there last week, they're still there. I don't buy that we're about to head off into high inflation. I think the economic environment is still very challenging. So I would use any opportunity to set a bet, of higher rates to actually buy into it here.
Priya, I'd like to build on this because it's a conversation I started the week on with Matt Hornback of Morgan Stanley, just how dominant the force will be, the force being here, supply, through the week. How important is Treasury supply for where Treasury yields go?
when everything else is equal, supply matters. But we're in an environment where everything is not equal. We've got tons of other sort of cross currents. And so I think supply matters on the day. I would also highlight that given the new market structure that we're living in, where liquidity just seems a little worse post-March, I think actually supply ends up being liquidity events for the market. So if I need duration and I know there's a big auction coming up, I might wait until the auction to actually buy. So I think we get sort of a lot more volumes in the auction week. So to that extent, it matters. But beyond the setup, I don't think supply matters when there's a ton of demand out there for duration.
Priya, I'm sure you've had the most amount of calls ever on real yields, perhaps since your time on Wall Street. And I'm just wondering, Priya, when you receive those calls at the moment, what are you telling people?
I'm telling them to watch the Fed. I think it's a Fed. It's not the stagflation thesis. I don't buy that that's what the market's pricing in. Real yields are really a function of Fed policy. And if the Fed is being dovish, and look at all the Fed officials in the last few months have come out extremely dovish. We don't even need to look at whether they're a hawk or a dove. They're talking about the virus risk, the structural damage risk. And if they're telling us they're not about to hike until PCE goes above 2%, which actually means CPI above 2.5 on average, and they're telling us that they might be extending out in duration, real yields can go more negative because that's the Fed tool really to try and force people out the curve to take more risk to help investment. So it's Fed policy, I think, that's driving real rates here. I would watch that September Fed meeting very closely.
So, Priya, before the reaction function has even been formalized, it looks like it's already in this market. And I just wonder whether we've already got de facto yield curve control in the Treasury market right now.
Yeah, I think market's not pricing in the first hike until 2025. That's telling you they've heard the Fed loud and clear that, it is a more dovish reaction function. I think that's well priced in. Even for the long end, you look at 10-year real rates, we're back to, last week we were at historic lows. That's also pricing in not just the hiking reaction function, but also in terms of how much duration they're going to take out of the market. So I think we're largely priced for a big move, which is why they need to not disappoint in September. If we don't get both forward guidance, framework review, and an extension of duration, I think then you could certainly see a big snap higher in real rates, which would be very detrimental to the recovery.
Priya Misra, fantastic to catch up with you. Priya, always a pleasure. Priya Misra there of TD Securities. Coming up on this program, the analyst action you need to know. That'll be on our morning calls. Then later, John Hancock's Emily Rowland joins us at the opening bell on the United States versus the rest of the world, with negotiations between China and the US very much a focus later in the week. In the bond market right now, yields drifting higher, up 3 basis points on a 10-year. Financials have had a bid over the last several days. Bank stocks doing nicely. JP Morgan down 25% on the year. This morning, it's up another 2.7% off the back of what you're seeing in Treasury yields. Your 10-year, 0.67%. Your yield is up 3 basis points on the day. In foreign exchange, euro dollar 117.90. Just a little bit of dollar weakness in the mix against a stronger euro. With the exception of the Japanese yen over the last few days rather, dollar yen just drifting higher, 106 spot 72. From New York this morning, good morning. You're watching Bloomberg TV.
The Census Bureau has asked Congress for a 120 extension. I don't know that you even have to ask, and I think 120 days isn't nearly enough.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Five minutes away from the opening bell in a beautiful New York City this morning. Good morning. Equity futures up 24 on the S&P. We advanced by around about 0.7%. That's the price action. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Deutsche Bank downgrading Deere to a hold, a 185 price target. The analyst signing a less compelling risk reward and increasing US-China trade tensions. That stock is negative by just 0.25% in early trading. Your second call, JP Morgan upgrading American Eagle to overweight, a $17 price target. The analyst saying it's a mispriced stock with premier positioning in the casual and athletic apparel space. That stock is up by 9% in early trading. And your third and final call, it comes from the team at Evercore, raising its Apple price target to $460, reiterating its outperform rating. The analyst writing that shares tend to outperform heading into new iPhone events. They're three of the movers this morning. Coming up on this program, John Hancock's Emily Rowland joining us for the opening bell in the markets at the moment. 4 minutes away from the cash open in New York City. Futures up nicely, up 0.7% this Wednesday morning, snapping back from Tuesday's losses with a bond market that just keeps drifting lower and yields that keep grinding higher. This is Bloomberg.
It's such an interesting new world.
The world is changing. For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
Give you
you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Snap at a 7-day winning streak in yesterday's session on the S&P. Losses yesterday, a bounce back this Wednesday morning, up 24 on the S&P 500. We advance 0.7%, 1% across the board here, with the Nasdaq up by 80. Switch up the board in the bond market. Treasury yields higher for a fourth session off the back of hotter than expected CPI in America. 0.66% is your yield on a 10-year, up a couple of basis points on a session this morning. Crude positive 2, up 2 percentage points to $42.45. And just in the last 10 minutes, the euro with another lift approaching 118 at 117.95. That's your cross-asset price action at the market desk with your movers. Here's Abigail.
John, popping to the upside. Lots of movers this morning, starting out with the shares of Moderna, the biotech company. The stock is soaring, in fact, up more than 10%. This on the news that the U.S. has contracted the company, actually up at this point up 8%, in the pre-market up more than 10%. On the news that the U.S. has contracted them for a $1.5 billion contract for 100 million doses of their potential vaccine. And this brings U.S. spending for COVID shots to $9 billion. And of course, none of those vaccines are proven yet. So really trying to lock those in once they're delivered. Tesla popping higher, and a 5-to-1 stock split makes it more attractive to retail investors and momentum players. We're now going to be looking at a roughly $300 stock as opposed to a $1,300 stock. Grubhub is also higher. This on the news that Dutch delivery company Just Eat had a very big first half. Their orders jumped 32%. They're buying, of course, Grubhub for $7 billion. That deal will close in 2021, and those Grubhub investors liking it. Viacom, it's interesting. The stock is higher despite fears of college football shutdown and what that could mean for TV ads. It could put $1.2 billion of TV ads at risk. In addition, sadly, Sumner Redstone, who built the media empire, of course, he has died at 97. Now, as for some other biotech movers on that vaccine news around Moderna, we do have mainly stocks trading higher in sympathy, including Pfizer and BioNTech and AstraZeneca. To the downside, Novavax down 2%. But, John, as you know, that stock is up more than 3,600% this year. So any of these biotech stocks involved with a possible vaccine really being rewarded in 2020.
I'm not going to pretend that I did know that, but I appreciate it, Abigail. Thank you very much. Abigail, thank you. About 2 minutes into this session, equities up by 0.9% on the S&P 500. The bid is in the financials. Bank stocks up by about 1.32% off the back of this drift higher in Treasury yields over the last 4 days. That's the story for the equity market. For big tech, the focus is on China. For more, here's Bloomberg's Scarlet Fu.
Yeah, the bid is also in for technology shares. Just like U.S. big tech, Tencent of China has been a clear beneficiary of the COVID lockdown. You look at the results, second quarter revenue beat analyst estimates, jumping 29%. As for its net income, that topped the most bullish analyst estimate out there. And this is all thanks to a surge in online gaming, which is its biggest business. One thing we didn't hear from Tencent, though, is any word on how the U.S. ban on its WeChat messaging app will affect its outlook. And this is critical because WeChat is the conduit for Tencent to distribute all its content, whether it's online games, fintech, or advertising to its 1.2 billion users, many of whom are in the U.S. and rely on it to communicate with friends, family, and business partners in China. These latest results also a reminder that President Trump is threatening a Chinese cash cow. Tencent went on a monster rally since its March low, up 55% versus a 12% gain in the Hang Seng Index, which in which it's the biggest constituent. Tencent's market cap swelled by more than $280 billion since then. You'll want to expect Beijing to take up the issue of President Trump's crackdown on WeChat and TikTok later this week when U.S. and Chinese negotiators meet to get an update on the Phase 1 trade deal. Specifically, the issues are, of course, China's agricultural purchases through the first half of the year and the dollar-yuan exchange rate. As you saw, Tencent ADRs are rising along with other Chinese tech shares. Meantime, you look at U.S. tech, and they are recovering from their 3-day sell-off. The Nasdaq currently up more than 1.1%, and the New York FANG index gaining about 1.8%, with all 10 members higher. The Nasdaq 100 ending its 3-day losing streak, which was the longest since early March, so really before the COVID crisis, the worst of the COVID crisis. It's not clear whether the recent declines, that switch out of recent winners into laggards like cyclicals, was only a pause in the rally of big tech or the start of something more significant. Matt Maley of Miller Tabak makes the point that if tech shares roll over and take out their July lows, then we could be seeing the start of something more significant.
Scarlett, thank you. Thank you very much. Some important questions there. What do you want to own, and where do you want to own it? Is it growth versus value? And if it's value, do you want to own it here in the United States or own it abroad, in Europe, internationally? John Hancock's Emily Rowland making the case for the US versus the rest of the world, saying the following: we still prefer high quality equities with a mix of cyclicals and defensives. While some factors that should benefit overseas equities have started to emerge, we haven't yet seen earnings estimates show solid signs of turning higher overseas. The US still looks relatively better to us fundamentally. Emily joins us right now. Emily, great to catch up with you, as always. Talk me through this, why it's still the United States over the rest of the world.
Well, look, we've certainly seen some resilience out of international equities over the last several weeks here, and a weaker dollar has been a key element of that. We've also seen somewhat better relative economic growth as PMI data for the Eurozone topped U.S. PMI for the first time since February. So those two elements have been supportive, but the final kind of leg that we're looking for in this narrative is for earnings estimates to start to turn higher overseas. We all know that stock prices follow earnings over time, and that fundamental backdrop is absolutely critical for us if we want to lean further in international equities. And while U.S. earnings estimates are bottoming and really kind of starting to ramp up on a next 12-month basis, we're not seeing that same element kick in overseas. We do want some exposure to international equities, but we want to do here is we want to overweight international growth versus international value. A bet on international value is really an explicit sort of overweight to European banks. We're not there yet. We much prefer U.S. financials. You embrace international growth. You own sectors like healthcare. You own sectors like technology and industrials. We actually think that there's an opportunity there to play those elements that are showing a rebound without sort of going over your skis and taking risk.
Can you walk me through the disinflationary bias